welcome everyone to the last meeting of the year, although there's committee meetings that will be going on, but last board meeting of the year. Call the meeting to order. We have myself, Vincent Sari, as chair present. We have vice chair, soon to be board chair, Andrew Bernier, present. We have trustee Griardi present, trustee Lanza present, trustee Menon present, trustee Muyo present. Trustee Oswald will not be here today. Trustee Santos present, trustee Votto present. Currently our council member liaison Foley is not here. Hopefully she will be joining us sometime soon. We have council leaderman, our CEO Roberto Pena, our CIO Prabhu Polani, and we have our COO Barbara. So welcome everyone. First item of the day, and sadly I have to say, is going to be the commendation of trustee Griardi. This is, I don't know if this is actually your last meeting, because I think you might have another investment committee meeting coming up still.
I have almost 3 more meetings
Go team.
after this.
Can we stack anything more on her before she leaves?
Motion not to approve.
But we have a commendation here. I want to read a little bit of this off and then comment, and then let other trustees comment as well. Whereas trustee Gia Griardi was appointed to the Board of Administration of the City of San Jose Police and Fire Retirement Plan in November 2014 as a public member, served as chairman of the Governance Committee 2016 and 17, and Investment Committee in 2019. On the Governance Committee, she was very involved in a lot of policy reviews, the charters and updates. She implemented the dashboard. I believe actually she chaired or pushed that initiative forward, which has been very helpful for us to have one source of administration items to go to look at things with respect to the board. She served on the Investment Committee for 3 of her 5 years, helping guide investment strategy, updating the investment policy statement, reflect improved governance standards, and help maintain the fiscal soundness of the system. She also served on the Audit Risk Committee and Joint Personnel Committee. It's just like unbelievable how much she did in such a short period of time. She offered stability and progressive views during a period of change in administrative staff and the economy, and has offered her leadership and guidance with FLSA, and was instrumental with the approval of the pensionable pay correction plan. I have to say that Gia's questions that I always noticed in every meeting were just always so spot on and so insightful and really helped move the conversation forward. I was thrilled that she agreed to chair the investment committee in particular, having started on that committee and then led it for the last year plus. Governance was an area that was very easy for her to manage. I don't know if that was just something that comes natural with your profession and your ability to lead, but it's been a pleasure serving with you, and it's going to be a huge loss for our board losing Gia, and hopefully some of the individuals that you've tried to move names forward are equally as talented. Other comments from trustees? Feel free if you have anything you'd like to share.
Or not.
Dick?
No, it's, I see Gia as not just a colleague, it's always been like a friend, even though we only see each other once a month, sometimes on different committees. But he's always been committed, and I say that when I see civilians who don't know our system, but knows the investment system, but doesn't know police and firefighters. She just got aboard really quick and filled in when there was vacancies, when we needed someone on disability committee, whatever, she was there. So I call her Miss Dashboard. I didn't know a damn thing about dashboards when I got here, and it was her. But her leadership and just being just a good person, and our sharing of Pacquiao the fighter, we would talk about many things. But I'll miss you, and of course to have safe holidays and the best for your family. And I hope you can come to one of our car shows in the future.
Yes, that's on my list of things to do.
Thank you for your service too. Appreciate it.
Great, nice.
I'm pleased to report that I have in fact had a beer with Gia on more than one occasion. She is extremely bright. and I agree with you, Vince, right to the point. We've had a lot of fun. We've done that, covered every subject under the sun, because we sort of come from the same industry. We will miss you, Gia. You've done a superb job on this board. Thank you.
I agree with what everybody's saying. We're definitely going to miss you. You brought a lot of value to this board. As Vince was reading off, I mean, you've pretty much had your hands in almost everything that we've done. As a member of the plan also, you know, when I talk to people out in the firehouse and they want to know, you know, about the other trustees, they would be very proud to hear and see that you're a true fiduciary of the plan and a steward of this plan, and you've done a lot of good. And it's people like you that it makes this plan work so well. And so, wish you were staying longer, but we are very happy for the time that we've had you here, and thank you for everything you've done.
Okay.
Oh,
I'm
can I
sorry, I'll go ahead.
say, so I've known Gia for a year. When I got on the investment committee, I made a point to sit down with her and understand the responsibilities. And I really appreciate, you know, all your insights. We're gonna miss you, but look forward to keeping in touch with you.
Oh, certainly. And let me just make a quick comment here, because I do feel a sense of loss going forward, not seeing you guys as frequently as maybe twice a month. But I did want to say that coming onto the board, I really didn't know what to expect. I've been in the investment industry for the last 20 years and in engineering prior to that. I developed a deep sense of appreciation for the work and the courage that police and fire have, which I never really had prior to coming here before. The immense amount of time and effort that you do for the local community, and now even for California, you're called to work. We really do appreciate all that. And hearing all of the risks you take and the sacrifices you make for your family, I think I've really come to appreciate, and that was something I didn't realize I would come away with. Coming here, I really wanted to learn what pension was all about, but it really truly changed my mind the day that we all attended the Michael Johnson Memorial, and that really kind of hit home where you guys really truly make the community and the environment safe here, and that truly makes me a fiduciary to ensure that you guys are well taken care of going forward as well. So that's really all I wanted to say. But I enjoyed also my colleagues in the investment industry. Of course, we have lots of conversation, and we have lots of conversation outside too. I'm going to miss you guys. You guys all became family over the last 5 years. Okay.
Thank you, Mr. Chair. So I just wanted to, besides echoing everyone's words, I wanted to thank Trustee Griarte on behalf of the plan members, on behalf of the office staff, for her commitment, hard work, dedication to this board and the plan members. I just remember many times, I'm a morning person, so I go to bed early at night, and I would get up in the morning and I would see these emails from Gia from 11 o'clock or 12 o'clock. I finally had to tell her one night, I said, why do you email me so late? I said, that's the only time I have after I take care of everything else I have to do. So if that's no dedication, I don't know what is. You are correct, she was involved in many of the committees, and she always was asking questions and making sure that we did our work and we completed what was expected of us. So again, on behalf of the plan members and the staff, thank you so much for your hard work, dedication, and undoubtedly for the support that you provided to our office as well. So thank you so much, and best of luck to you. And here is the plaque. The check is inside.
Can we open it now?
Yes.
Okay, terrific. So, orders of the day, we have none, so there's no sunshine to wave either. So I'm looking for approval of the consent calendar.
So moved.
Okay, I have a motion by trustee Santos, second by trustee Muyo. All in favor?
Aye.
Any opposed? No. Okay, that carries. I just want to comment and make sure I bring your attention to one item, and this is, I know it's in here. Item 1.4E, I'm assuming you've all reviewed that. There was one particular message and communication that council provided to the city regarding the proposed ordinance regarding survivorship benefits for police members. I appreciate those comments and submitting that to the city so that they're aware of that one minor change. So thank you very much. Okay, item 2, oral update from the CIO.
Thank you, Mr. Chairman. Firstly, I want to thank Trustee Griardi again for all the support of the investment team and for her work as chair of the IC, and particularly for being part of the ad hoc committee. The most important thing that we can do for our plan is improve governance. And so her insights and her support and feedback throughout the process was very useful. So thank you again. I know I'm not off the hook yet because she's demanding to see some more stuff at the coming IC meeting. So, also, just an update for the board. I was at the Stanford Investor Forum in November, mid-November, and very useful place to be in terms of information sharing. Many of my peers were there from some of the large sovereign wealth funds. So a very interesting exchange of views and ideas. And there were two parts to the conference. One was the Institutional Investor Conference, and the other one was the Family Office Conference, which I was also invited to, which was really eye-opening to me because we tend to think that on the institutional side, we do things better than the family office side, but it was really, Drew shaking his head. So he knows how nimble and flexible and knowledgeable that family office investors are. So I truly learned something from that. Moving on, I know we're going to discuss performance, but I did get the flash report for October 31st and quickly wanted to share that with you. The plan as of October 31st, fiscal year to date, returned 1.8% compared to the policy benchmark, which is 2.1. And calendar year to date, the plan is up 10.3 versus the policy benchmark of 9.8%. And so these are, of course, preliminary numbers. It's a flash report, but it should be pretty close to the actual numbers. With that, I'm happy to take any questions, or we can move on to Makita and Newberger.
Any questions? Okay. So item 2B, second quarter review of the private equity by Newberg Berman, or staff.
Good morning. I believe we have Casey Boyer from Newberger Berman on the line to walk through the performance report.
Casey, are you there?
Yes, hello, I'm here. Can everyone hear me?
Yes.
Yes, we can.
Thank you.
Okay, perfect. So I can't hear you all super loud, so if you have questions, just talk loudly and I will be happy to take those throughout the presentation. First of all, just want to thank you for inviting us to present quarterly. It's always helpful to make sure you all know what we're doing on a consistent basis and keeping up with the program quarterly. So with that, I'll go ahead and turn to page 1 of our presentation. It is a good overview of both the Newberger program partnership with the San Jose Police and Fire, as well as the legacy commitments that you have made over the years. So the first column is the legacy, the second is the Newberger, and then you can see the combined investments on the right. So the Newberger partnership was established in May of 2017. The report you're looking at is as of Q2 2019, so right at the 2-year mark of our investing and the close of the program. We currently have $266 million of fund size and commitments that we're working to commit. Of that $266 million, approximately 60% of that has been committed to investments, and you can see the $159 million of commitments that we've made so far. With that, of the $159 million that we've committed, approximately $50 million of that has actually been called, and that is about 31% of your total committed at this point. And as you know, private equity funds call over time, so that contributed capital amount will grow over the years. Probably the biggest difference from Q1 to Q2 that you'll see in this report is this is the first quarter that we were actually able to make a distribution back to San Jose, so that's always a positive thing. You can see we made a $202 million distribution. Most of that was coming from co-investments that had done some partial realizations, and that is key to our investment strategy and a big reason of why we put co-investments into our portfolios. So the performance continues to look strong on an early, with it only being 2 years into the program. We currently have a net multiple of 1.2 times. In Q1, it was 1.1 times, so you can see, continue to see value creation there. Turning to the next page, page 2 and page 3 highlights all of the underlying legacy investments that were made prior to the Neuberger partnership. As you know, a lot of these investments have been made and have been in the ground for a very long time, some of them with a vintage year of 2005. So a lot of those, you won't see a lot of performance movement from quarter to quarter. A lot of those have likely are kind of stagnant in kind of what their performance overall will be. But pages 2 and 3 are meant to show the performance on an underlying basis and how that is benchmarked against peers. So on the right, you will see the IRR and MOIC quartiling metrics for each one of those partnerships that was invested in. And if you turn to page 4, this is the benchmarking for the Neuberger portfolio. As you can see, a lot of information is still not meaningful, meaning that the investments are very recent and the benchmark and quartiles for those investments aren't even published yet, so we are not able to actually provide a benchmark. You can see the first 2 investments on those pages have a vintage year of 2016 and 2017, so we were able to put the benchmarks there. As time goes on, all of these will continue to be filled, and you'll be able to get a little bit better idea of where these underlying investments are benchmarked against their peers. Turning to the next page, page 5 and 6 is an analysis showing the investments by vintage year. So essentially, when each investment has been put into the ground or has been called capital from. And so you can see on page 5, the pie charts are based on the commitment amount. So you can see when the Neuberger partnership started in 2017, 2018, we really started to put additional capital into the ground, and you can see how on the top right chart, the Neuberger chart, how that's building out. As we continue throughout the years, the 2018 and 2019 will obviously get smaller as we add years 2020, 2021, and so on. And you can see on the bottom, the combined funds, which includes both the legacy and the Newburger, and how you're actually diversified across vintage years, starting in 2005. The next page, page 6, is the same analysis, but instead of using the commitment amount, it actually uses the net asset value. So you can see for Newburger, 2018 is currently the largest part of the pie, but again, that will continue to change as the investments in 2019 are continuing to call capital and grow in value. Page 7 and 8 is an analysis by asset allocation, so asset class. So it shows both legacy, Newburger, and the combined multiple of invested capital for each asset class. For Newburger specifically, you can see that large cap buyout on page 7 and special situations on page 8 have been the primary early drivers of our performance so far. And looking into that even further, you'll be able to see on some of the next pages what types of those investments are driving that. And so with that in mind, if you look on page 9, this is the same analysis using the investment type. So we have 3 investment types within the Newburger portfolio. We have primary investments, secondary investments, and co-investments. You can see the co-investments at 1.23 times are the highest, with secondaries coming in as a close second at 1.19 times. And those are really the primary drivers of the early strong performance. And that's exactly what we would expect. Co-investments are direct investments into portfolio companies. So a lot of times we're able to see the earlier returns from one company as opposed to a primary fund investment where there may be 3, 4, 5, 6 companies, and the performance is a little bit muted. I won't go, so pages 10, 11, and 12 are the exact same analysis, just using IRR. So it generally tells the same story. You're seeing large cap buyout, mid cap buyout, and special situations doing very well within the Newburger portfolio. And on page 12, you'll see the secondary investments doing very well on an IRR basis, as well as co-investments. Moving on to pages 13 and 14, there's a lot of words and a lot of numbers on this page, so there's a lot of detail that we wanted to make sure you obtain from all the underlying investments within your portfolio. But the big takeaway here is you're able to see on the far right the gross IRR and gross MOIC of each underlying investment within the legacy portfolio and the Newburger portfolio. This includes all of our primary fund investments, secondary fund investments, and co-investments. You can see that overall, on the very bottom of page 14, you have a total gross IRR of 9.5 times with a 1.44 gross IRR. And then you can also see the split out and the breakout between the legacy investments and the Newburger investment. So that is, that's the presentation. I'm happy to answer any questions that anyone may have.
Any questions? Gia?
I have a quick question. Casey, where is your co-invest out detailed in the page 14 of your slide? Is that in the special situation, or is that sprinkled in with the different sub-asset class, venture, large cap, mid cap?
Yeah, it's in throughout the entire portfolio. There's not any venture, but it's mid cap, large cap, and special situations.
Oh, I see. And what % of your co-invest is your total commit?
It's about, we put co-investments and secondaries in kind of what we call an opportunistic bucket, because we want to be able to move around those investments based on the market and the opportunities that we're seeing. But in general, our allocation there for your program is approximately 30%.
Okay.
Andrew?
Casey or Brian, on slide 4, investment 35, knowing that we're in open session, is there any high-level summary you could give explaining what's going on?
Yeah. It does look a little bit of a sore thumb right there, but the bottom line is that it is very early, and that particular fund has only made one investment to date. So essentially what you're seeing here is the J-curve, meaning they've made one investment which is held at cost. That investment is doing fine and doing exactly what they would expect it to do, but it's very early on, and so they haven't written it up at all. It's held at cost. And then the reason you're seeing the negative returns in your report is because they are still calling capital for fees and expenses. So you're actually just seeing a little bit of the one investment held at cost, and then the fees and expenses get put on top of that, and that's what makes it a little bit negative. But that is not a fair presentation of how that fund is actually doing. It's just a little bit early.
All right, appreciate it, thanks.
Mm-hmm.
Other questions? I have a question on the reporting. So I'm trying to square page 1 and page 14, and if I just simply use the legacy investments, in one case you're reporting gross IRR, and another page, on page 1, you're reporting net IRR, but the number's the same. So you've got a 9.3% return from the legacy portfolio gross on page 14.
Yeah, I'll
Okay, thank you,
respond to
Brian.
that. This drives me nuts, but it's actually a Newberger compliance thing. So when we say gross on pages 13 and 14, that's actually net of the fund, the individual investments, fees and expenses. It's gross of Newberger Berman fees and
Perfect.
expenses.
Thank you. And I know that you're not spending much time on the legacy portfolio, but in looking at the investments, there's been about 16 investments. Half of them are in the first and second quartile, the other half are the third and fourth quartile. Would you just simply come to a conclusion that we've had middling returns on the legacy portfolio, or is there anything different that you might look at to come to a conclusion there?
Yeah, I mean, there's definitely some good performers in there. And what I would say about benchmarking in general is it's very hard in private equity to really benchmark everything appropriately. So we can very much benchmark, for instance, here on pages 2 and 3, we're using benchmarks such as a fund-to-funds index or a private equity index. So we try as closely as we can to mirror the investment into the appropriate benchmark. However, there really is no good benchmark that is exactly the same as what your investment would be. And so I always tend to take benchmarking with a grain of salt, knowing that the peer benchmarking that we're also using is based on those funds actually reporting data. So, it's also not a perfect database that you're comparing against. So benchmarking is important because you want to make sure that the funds you're picking, the investments you're picking are performing, but you do have to take into account that it is not perfect. And so, you know, you have to think about that as well. Overall, the performance of the legacy investments, you know, some of them are good and some of them are not so good. I would say that none of them have actually lost any capital. So on just an absolute basis, you're not behind, but yeah, sometimes it happens.
Any other questions?
Yeah, just, so like the 2005 legacy portfolio, I mean, are those like done or they still open?
Yeah, so, you know, the funny thing about private equity investments is they say that they're going to last a certain period of time, and they last far longer than that. And then you put a bunch of those in a fund of funds product, and you get something that lasts even longer. So while they are not going to be calling additional capital, there will probably be a long tail to those funds.
Thank you.
Okay, thank you very much for this report.
Thank
Gonna
you,
move
Casey.
on
I appreciate
to-
your time.
Thank you.
Thanks, Casey.
So 2C, presentation of second quarter private market reports by Makita. And I just want to remind everyone, if you have questions, please, if you can speak into the mic so we capture everything.
Good morning, Hannah Schreiner and Chris Theodore from Makita Investment Group. So following Newberger's review of the private equity performance, this report is going to cover private debt, real estate, and real assets. As a reminder, it is as of June 30th. The private markets, due to the nature of the underlying funds, they do report performance with a lag, just due to timing it takes for valuations. So when I turn it over to Chris, he's going to cover the 9/30 performance of the total fund. But diving into the 6/30 private markets, starting on page 3 of the Makita report. This is a snapshot of the total program performance as of 6/30. You'll see the total, the top line there over at the far right, the net IRR at 8.3%, which is up about 20 basis points from the previous quarter. The total value multiple is at 1.3, which is flat from the previous quarter. And underneath the total alternatives account, you see the legacy private equity portfolio. And just following up to the question from the last presentation, if you look at the far right, the net IRR of 9.3, and then the total value multiple of 1.5. Right below that, you see the Newberger Fund of 1, as reported by Newberger. The far right, they have a 19% net IRR with a 1.2 total value multiple. And we'll go through the last 3 portfolios there: private debt, real estate, and real assets. So if we turn to page 5 of the Makita report, this breaks down the private debt program. There's a total of 12 partnerships within the program, so 1 new commitment was made during the quarter. The committed capital at $529.5 million, capital called at $465.3 million, $350.3 million in distributions with a reported value of $185.1 million. That represents 5.1% of the total retirement plan assets versus a 4% target. So it is overweight its current target, but as a reminder with private markets, even though it is above target, you'll continue to need to make contributions to new funds, given, you know, when older funds start to make distributions, you need to continue that to maintain target. Looking at page 6, snapshot of the activity during the second quarter. $7.6 million in contributions were called from 2 of the underlying partnerships. Cross Ocean ESS Fund 3 was a 2019 fund, so $404.8 million was called during the quarter. Octagon CLO Opportunity Fund 3 called $2.5 million, which is a 2008 vintage fund. An aggregate of $19 million in distributions were received during the quarter for 3 underlying partnerships. The Cross Ocean Fund 2 was a 2006 vintage year, Medley Opportunity Fund 2010, and then Shoreline China was 2014. Just to highlight, the Cross Ocean ESS Fund 3 was a new commitment made during the quarter of $32 million. If we flip to page 8, looking at the program performance for the private debt, the top line there you will see over on the far right, about 4 columns in the net IRR of 5.4%, which is down 10 basis points from the previous quarter. Investment multiple of 1.2. The fair market value increased by 1.9 million after adjusting for capital calls and distributions. That increase was due to increase in valuation of Cross Ocean Fund 2 of 2.2 million or 3.9%, and then also Park Square Credit Opportunities of 0.9 million or 2.1%. That increase was offset by a decrease in valuation of the Medley Opportunity Fund 2, down 1.1 million or 4.8%, and then also White Oak Direct Lending, which was down 1 million or 8.5%. Turning to page 12, looking at the real estate program. Total of 13 partnerships within this program. Capital that's been committed is 216.4 million, with 139 million being called. Distributions totaling 76 million, with a reported value of 101.7 million. Net IRR of 13.4%. This portfolio represents 2.8% of the overall retirement plan, slightly below that 3% target. Looking at page 13, there was 16.1 million called from the retirement plan for the real estate program from 4 underlying partnerships. Torchlight Debt Opportunity Fund 6 called 7.5 million. That's a 2017 fund. DRA Growth and Income Fund 9 called 5.1 million. KSL Capital Partners 4 called 1 million, and then European Property Investors Special Ops 4 called 0.8 million. The plan received 4.2 million in distributions during the quarter from 2 underlying partnerships, and then there were no new commitments made to the real estate program. If we look at page 15 and 16, you'll see the total program performance summary. The top right, the net IRR, 13.4%. That is a decrease of 50 basis points from the previous quarter. Fair market value increased by 1.1 million or 1.2% after adjusting for capital calls and distributions. That increase in valuation was due to an increase in the Realty Associates Fund 10 of 0.5 million or 10%, and then also European Property Investors Special Ops 4, which increased 0.5 million or 3.1%. Turning to page 19, getting into the real assets program. So infrastructure and the natural resources, there was a total of 5 partnerships. There was 1 new one made during the quarter. The committed capital totaling 59.2 million. Capital called is 34.6 million, with distributions of 4.4 million and reported value of 35.4 million. The net IRR of 11.3%. Currently, the program represents 1% of the overall retirement plan versus the 3% target. So this is one of the areas where the total fund is underweight. If we look at page 20, 2 million was called from the plan from 3 underlying partnerships, Brookfield Global Infrastructure Partners 3, and then Limerock Partners 8. And then the plan received 0.7 million in distributions from Global Infrastructure Partners Fund 3, and then Brookfield Infrastructure Fund 3. There was the 1 new commitment, as I had mentioned, to a Global Infrastructure Partners 4, 6 million, and then 7.2 million to the Kimmer Ridge Energy Fund 5. Looking at page 22, the total program performance summary. Net IRR of 11.3%. Again, this program is still in the early stages. As you see, the first vintage year there is 2016. So about half that portfolio on the far right, you see the net IRR has not materialized yet. So those newer 2017 and 2019 funds currently don't have enough activity there to register the net IRRs. The program increased by 7.7 million or 2.2% during the quarter, which was mainly driven by a valuation increase of the Brookfield Infrastructure Partner Fund 3. The remainder of the document includes some market commentary on the individual asset classes for your reading if you'd like, and happy to take any questions.
On the private debt, what's the typical life cycle of these? I mean, do they return the money in 2 to 3 years, or?
It'll depend on the underlying, fund structure. If you look at the performance on page 8, and you'll see to the point that was brought up on the legacy funds on private equity, you'll see the 2010 funds and 11, their unfunded commitment is currently at 0, so they're currently still in the distribution phase, but they could still, linger around with that tail end, as Brian had mentioned.
And the typical lifespan of a private debt fund is roughly 5 to 8 years.
5 to 8 years. And do we do any international exposure in private debt?
Yeah, so, the most obvious one here is Shoreline China, which in fact, when, we don't talk necessarily about the details of the underlying investments, but I think it's pretty well known that it's sometimes challenging to get capital out of China, and that can influence performance. We have a fairly large exposure within Europe relative to the US, and most of the work that we're currently doing is focused on US opportunities. But as we look internationally, which we absolutely do, we have to consider the effect of currency.
And is a lot or some of the private debt related to PE deals, like private, so it's the debt side of PE deals, or?
Yes, and a lot of it.
A lot of it is, okay.
Councilmember Foley.
Thank you. So for many of you, this is your business and you understand all this terminology really well, but I don't, so I had a clarifying question for you. On slide number 19, you referred to it being underweight. Can you tell me what that means?
On 19, so the target allocation within the total retirement plan for real assets is 3%, and currently the assets that are committed to that are at 1%.
Okay. That's what you mean by, okay.
Yeah.
Thank you.
And due to the nature of the investment, sometimes it takes time to call capital. So you commit capital to a manager, and sometimes it'll take time for them to actually call it from you. So that's why there's sometimes, a bit of time in between
Why there's the
ramping up
lag.
to their target.
Got it. Okay. Thank you.
One thing I want to bring your attention to as well is page 3. There's been a lot of discussion around plan fees and particularly alternative investments and the expenses related to it, alternative investments. But you can see here that the net IRR for the program for all the alternatives is 8.3%. Our assumed return for the plan is 6.75. So clearly, this part of the portfolio is exceeding the assumed return. Naturally, it's the other parts of the portfolio that are hindering, at times, our ability to meet our assumed return. Could be the low interest rate environment we're struggling with, but I just think it's important to point this out since there's been so much discussion and attention paid towards alternatives. It's actually served the plan well. Any other questions? Okay, let's move on to 2D, which is the presentation for the third quarter report.
Thank you. So we'll be presenting the Police and Fire Department Retirement Plan Quarterly Review. This is as of September 30th, 2019. I'd like to start the presentation by flipping to page 5 with some commentary on world markets through the third quarter of 2019. Year to date, through that time period, we've seen broad-based strength in asset class returns. In the year-to-date column there, you'll notice we list several index returns from many of the broad-based indices across several asset classes. We see domestic equity has been especially strong in the year-to-date period, up roughly 20%, broad-based through the different sub-aggregates. Foreign equities up in the low double digits percentages. Fixed income up in the high single digits percentages. Particularly the third quarter of 2019 was an interesting time period. The quarter started off pretty rocky. There was some interesting commentary regarding weak manufacturing data, as well as increased trade fears, which kind of spooked the market. This all was turned around by the Federal Reserve's lowering of interest rates. The Federal Reserve lowered interest rates twice in this quarter period, once in August, once in September, and then subsequent to the end of this quarter, they also lowered it a third time in a row in October. Fast forwarding to today, some of those same fears that we saw in the beginning of the quarter still proliferate in the market today, in addition to some worries in the market over a potential presidential impeachment as well, which have hindered some market growth despite strong corporate earnings that we have seen throughout the market, especially in the U.S. Some other themes that we'd like to touch base on within domestic equity, especially large cap stocks have continued to outperform small cap stocks. U.S. domestic-based stocks have continued to outperform international stocks. And fixed income has continued its rally in the year-to-date period, driven by, as I mentioned, the lowering of fixed income, the lowering of interest rates. If we wanted to look, we could flip to page 6, details the S&P sector returns on the year. Pretty much showing that strength in the U.S. market has been very broad-based, with the lone exception being energy returns. Energy returns down roughly 22%. Over the trailing one-year period, down 7% in the third quarter. Flipping through, we also have several slides on 7 and 8, which detail rolling 3-year returns, comparing U.S. equities versus both developed market equities as well as emerging market equities. We've continued to see the trend of U.S. stocks outperforming international stocks. And then I'd like to continue through to page 11, which highlights U.S. real GDP growth. Real GDP growth on a trailing 12-month basis has been okay at roughly 2% on the trailing 12-month number. While on the next slide, page 12, we detail U.S. inflation as measured by seasonally adjusted, as measured by non-seasonally adjusted CPI, which comes in at roughly 1.7%. And then on page 13, we detail the strong U.S. employment market, with U.S. unemployment near record lows at roughly 3.5% at the end of the third quarter 2019. Any questions on broad-based market commentary before we jump into results for the plan? Great. We start the results for the plan on page 22 of the Makita report. As a reminder, this is as of September 30th, 2019. You'll notice the asset allocation policy looks a bit different from the second quarter report. In the August meeting, the board voted to implement the 11.9% risk policy, shifting the growth bucket from 56 to 61% policy target, the zero beta bucket from 29 to 27%, and the other bucket from 15 to 12%. Flipping through to page 23, you see the total plan valued at roughly $3.65 billion. We have an estimate through the quarter to date yesterday, which Prabu had touched on in some of his commentary earlier. We estimate the plan is up roughly 2.6% in the quarter to date period, bringing the fiscal year to date return to roughly 3%. As of September 30th, 2019, the year-to-date return at that time was 8.7%, outperforming the policy benchmark of 8% and the investable benchmark portfolio of 8.3%. And the same could be said in the one-year trailing period, up 3.4%, outperforming the policy benchmark by 30 basis points and the investable benchmark portfolio by 40 basis points. Over the longer time periods, you see the total plan up 6% in the 3-year period, 4.3% in the 5-year, 6.1% in the 10-year, and 8.3% since inception. We'll focus on some asset class returns before we jump into manager level returns. Much of the portfolio strength in the year-to-date period has been driven from the growth bucket. We saw the growth bucket up roughly 12.3% in the year-to-date period. The strong drivers of returns there being both global equity as well as U.S. equity, up 19 to 20-ish%. The zero beta bucket of the portfolio is up roughly 3% in the year-to-date period, has outperformed the zero beta benchmark by 110 basis points, driven by short-term investment grade and immunized cash flows, while absolute return has contributed nicely, up 6.8% in the year-to-date period as well. The other portion of the portfolio, as noted on page 26, up roughly 5.1% in the year-to-date period, outperforming the other benchmark by 90 basis points, driven mostly by core real estate holdings, which represents 4.1% of the portfolio and up 6.7% in the year-to-date period, outperforming its benchmark nicely by roughly 290 basis points. Continuing through to page 27, it jumps into some manager-level returns within the asset classes. We'll note that within global equity, we continue to see the same trend continuing where growth stocks have outperformed value stocks. Your growth manager, Artisan Global Opportunities, up roughly 24.2% in the year-to-date period versus Artisan Global up 16.2%. Continuing through to U.S. equity, we show your large cap manager outperforming your small cap manager over the year-to-date period as well, with Northern Trust Russell 1000 up 20.6%, while the small cap value benchmark index is up 12.9% in the year-to-date period. Within international equities, we'd like to highlight the performance of Oberweis International Opportunities Fund. Oberweis was down 4% in the quarter-to-date period, underperformed by 320 basis points. They are your global small cap growth manager. In looking into the portfolio and understanding the performance in the quarter, one of their holdings was subject to a short sale attack, which drove performance in the quarter lower. But you'll note that over longer time periods, Oberweis has done a very nice job for you all in the 5-year period, up 6.5%, ranking in the 18th percentile versus peers, and since inception, ranking in the 28th percentile versus peers.
Can I ask you for a favor? Can you, when you are going through the report, can you call the number of the page so that if someone is watching or someone is lost trying to find out what we are, they can tell what you're referring to?
Sure.
Thank you.
And that was noted on page 29 for clarification. Continuing through on page 29 within emerging markets equity, we also continue to see growth managers outperforming value managers. And we also see the listing of 2 of your new emerging markets equity managers. At the bottom of page 29, that's RWC Emerging Markets Equity. It was funded in September 2019. And Wellington Emerging Markets Systematic, which is on page 30, was also funded in September of 2019. Continuing through on page 30 to marketable alternative equity has been a nice driver of performance in the plan as well, up 9.1% in the year-to-date period, outperforming its benchmark by 130 basis points in the year-to-date period and 220 basis points since inception, with all 3 managers outperforming nicely since inception as well. Hannah had touched base on your private markets accounts. These also detail some of your time-weighted returns through the September 30th period, which is also lagged to your June 30th values. So I'll flip through to page 35, which continues with high-yield debt. High-yield debt has been a strong driver of the portfolio of the retirement plan's returns in the year-to-date period as well, up 13%, outperforming the blended benchmark nicely. You'll note your manager, Beach Point Total Return Fund 2, up 6.9% in the year-to-date period, seemingly underperforming its benchmark by 450 basis points. We'd like to highlight that Beach Point holds a portion of the portfolio, roughly 23%, in bank loans. Bank loans are a little bit different from high yield in that they rank slightly senior in the capital structure to high yield. So in a risk-on market environment, we would expect high yield to outperform bank loans. There's also a component of bank loans that adjust to interest rates, so it's a floating rate investment. So as interest rates decrease, your bank loans will reflect that as well, where high yield is more of a fixed-based investment. Within your credit portfolio, also on page 36, in the year-to-date period, we saw emerging market debt up 9.8%. Your two managers there, Blue Bay and Wellington, both up in roughly that 10% area. The zero beta portion of the portfolio up 3% in the year-to-date period. You see two recently hired managers there on page 36. That's the BlackRock Government Credit Index, as well as the Insight Immunized Cash Flows, funded in the middle of this year. And flipping through to page 37 starts the absolute return portion of the portfolio. Absolute return was up 6.8% in the year-to-date period, outperforming its benchmark by 500 basis points. You'll note of your 5 global macro managers, 4 out of 5 have outperformed over the past year. So strong performance from managers there, as well as within your relative value portion of the portfolio. 4 out of 5 of your managers have outperformed over the trailing one-year period as well. Page 38, we'll touch base on the other portion of the portfolio. Other represents 11.2% of the portfolio, has returned 5.1% over the year-to-date period, mostly driven by core real estate, up 6.7% in the year-to-date period and outperforming by 290 basis points. Within commodities, the retirement plan utilizes Credit Suisse risk parity, up 3.7% in the year-to-date period. And we'll also note that since inception, we do see a negative return there, reflecting a difficult commodity environment over that time period. Credit Suisse has done a nice job of protecting capital in that tough environment. You'll notice that they have outperformed the benchmark by 350 basis points, but also negative performance over that time as well. Wrapping up on page 39, we also have TIPS and sovereign bonds. These are two indexes that were hired at the end of last year and build out the remainder of the other portion of the portfolio. Any questions here on manager returns?
Questions on managers? I do have one question. You did touch on Beach Point, and I noticed during the quarter about half the capital was withdrawn from Beach Point. And I noticed both Beach Point and Blue Bay are on your watch list. We've had these managers for over 5, nearly 6 years. And both managers have been consistently underperforming. At what point do you decide it's time to terminate the managers?
I think in thinking through how we look at the credit portion of the portfolio, we've seen a lot of active managers underperforming in this market environment. Particularly Beach Point, we are unsurprised by the underperformance given the environment that we've seen that I kind of touched upon, where bank loans have underperformed high yield. That being said, we do keep a close eye on these managers and also including them on our watch list over the 3 and 5 year periods does designate the underperformance that we've seen versus its benchmark. Although I wouldn't say it's within the realm of reason where we would be recommending an imminent termination.
Probably maybe you or staff can comment on the fact that there's a significant, 50% withdrawal of capital. Is that an indication that that's where we're heading?
Yeah, and you're right. And it's less to do with the manager than with the asset class itself. And I think we are entering an environment where I don't feel very comfortable with credit exposure, especially high yield credit exposure. Obviously, as Chris said, in a risk-on environment, high yield is going to do very well. And at some point, I know we've been waiting for this for a while, but we may be closer to the end now where it's going to be risk off and the asset class is going to suffer. So the entire high yield exposure is pretty small, and that's the direction we're moving towards, so reducing that.
Other questions?
Just a comment, I'm glad that you raised it. I think it's as we go into the last investment committee, I think that would be one thing that I think is still missing in our policy, where we really should kind of have some really clear guidelines around when certain managers underperform, what is the trigger upon which we make the decision to terminate? And I know it's dependent upon the market cycle, dependent upon the asset class, but I think we still should have a clear articulation of it, and I don't think we have gone the one level deeper in our policy around that.
Yeah, thank you. And we can discuss that further at the IC this month.
Great.
You want to continue anything more, or are you done with this report?
That concludes my comments on the.
Okay. I do have a couple more questions. On page 47 shows the net cash flow. Does that include called capital for alternative investments, or is that simply distributions to beneficiaries?
That would represent distributions to beneficiaries.
Okay, so we're at a point now in a one-year period where we're paying out $270 million on an annual basis, something to be aware of. Over the course of 4 years, we paid out $1 billion from the plan, and our plan's got $3.6 billion in it. So this points to the positioning that staff has guided us towards and consultants, why we're not as aggressive as many of our other peers. That's a pretty significant withdrawal rate if you think about it. I just wanted to point that out. The second thing is on page 5, where you started with the various indices, and this is really kind of a somewhat leading question and maybe a generic question, but if we look at the indices, and this has been a constant thing that's been brought up in the media in particular, if you look at the 5-year performance of the S&P 500 and you compare it to the foreign markets, whether it is the EFI that earned 3.3 or emerging markets that earned 2.3%, or you go and stretch it to a 10-year period and you look at the S&Ps earned 13% per year, again compared to international and emerging, I mean, clearly it would have made sense in hindsight to have a large allocation to U.S. What about going forward? How do you now look at this, and what are your expectations going forward for the next 5 to 10 years for these markets?
Yeah, we think valuations are much more attractive abroad than they are here domestically in the U.S. As you touch base on some of those time periods that we note in the index returns, one thing we would like to note is that over the 5 and 10-year period, we've been in the same market environment. We've been in the same market cycle where things haven't shifted or adjusted at all since the recession that we saw really in 2008. So going back to that time period, we're really looking at a time period bias where markets have performed very similarly over a long period of time, which we haven't necessarily seen before. But we do I don't believe we show the slides in this performance, but we do keep track of valuations, PE ratios between U.S. stocks, developed market stocks, and emerging market stocks. And then looking at those valuations, developed markets and emerging markets are much more attractive to us. And I think that's reflective of the asset allocation policy as well, where especially compared to peers, you all have a higher allocation towards emerging market equities compared to peers.
Is there any material in here in your appendix or other data that supports the valuation work? And if not, that's okay. It would be important, though, in the future to include that, to support that, particularly for our messaging with stakeholders, to validate why we're not moving everything towards the S&P 500 today after seeing these kinds of returns.
No, that's a great point. We'd be happy to add those slides for you.
I think the one thing which I would add is, and I think the Wall Street Journal might have carried this, is that if you adjust for the sector exposures, meaning that the U.S. has much bigger technology exposure, for example, then the valuation differentials are not as much. And so the performance differential as much explains the fact that certain sectors, industries have done far better in the last 10 years. And I think the change environment may require that those other sectors do better.
Right. Well, it's an interesting point, and just a comment I'll make on that. The S&P 500, most people would typically think that it's equally weighted. You have $1 in each of those 500 stocks, and that's not how it works. If you just took the 10 largest companies, which many cases are heavily weighted towards technology, it accounts for about 22% or so of the weighting and performance of the S&P. So it's very much skewed to your point to that. Any more questions other than mine? Let's move on to 2E, the healthcare trust.
Great. The healthcare trust performance, we'll note, is also through September 30th, 2019. Beginning on page 20 is where we'd like to start. As of September 30th, 2019, the retirement plan healthcare trust was valued at $154.99 million. We'll note that growth consisted of 56% as a policy target, zero beta 29%, other 15%, and that all these asset classes were within IPS range, as noted on page 20, that right-hand column within IPS range. Similar to the retirement plan, we did run an estimate for the healthcare trust. We'll note that we believe the healthcare trust is up roughly 3.1% in the quarter-to-date period since ending here in September 30th. That brings the year-to-date return to up 13.9% and the fiscal year-to-date return to up 3.2%. As of the September 30th, 2019 period, the healthcare trust gained 10 basis points in that quarter-to-date period, is up 10.8% in the year-to-date period, up 2.4% in the trailing 1 year, up 4.5% in the 3-year, and up 3.3% in the 5-year. Similar to the retirement trust, our commentary is echoed where growth has driven much of the performance in the year-to-date period, with U.S. equities up 20.1% in the year-to-date period, international equities up 13.1%, and emerging market equities up 6.3%, driving that 10.8% healthcare trust return we saw year-to-date. We'll flip through to page 23, touch base on the managers briefly. Within public equity, we'll note that you all use index managers through Northern Trust for each of your public equity sub-asset classes, including U.S. equity, international equity, and emerging market equity. Continuing through to page 24, within zero beta, we saw zero beta up 1.8% in the year-to-date period. Another index manager there within short-term investment grade bonds, which represent 28.3% of the healthcare trust, up that 1.8% that you see in the year-to-date basis. Within the other portion of the portfolio is where we see some differentiation from the retirement plan. Other represents 14.1% of the healthcare trust, up 15.5% in the year-to-date period. Within core real estate, we've noted especially strong performance within REITs. You're invested in a REIT index, Vanguard REIT Index Fund, up 28.3%, which is driving core real estate performance and also other asset class performance. And similar to the retirement plan on page 25, within commodities, the healthcare trust is invested in Credit Suisse risk parity, which is up slightly on the year-to-date period, but in a tough commodity market over long-term periods has been negative, and Credit Suisse has done a nice job of mitigating some of that market return. Any questions here on the healthcare trust and their managers?
Any questions? No? Okay, thank you very much.
Thank you all.
Okay, moving on to 3A, discussion action on compensation benefits for the Office of Retirement Services, the CEO and CIO. So we'll take this in order, first on the CEO side. So just kind of, maybe, Eswar, you're really one of the newer trustees, so this is a new process for you. Some of you who've been through it may have kind of forgotten the process we go through. We, in closed session, do a review and discussion of the CEO and CIO. Federated does the same thing. Following those discussions, we prepare a report we have been using the city's system of evaluating the performance. We just, as an aside, the Joint Personnel Committee is looking at establishing our own methodology, very much being driven by the work that was driven by the civil grand jury's report, saying we need to have more specific measurable performance metrics. We're in the middle of doing that. Actually, we're in the later stages of doing that. And I would suspect that sometime next year, we'll have that built out and our process will shift in how we're doing that, away from the city's process to our own process. A large part of that latitude was granted through Measure G and our ability to hire and compensate within ranges, city-approved ranges, their compensation levels. But where we sit right now is there are performance metrics that we have that we go through from the city perspective. The way the measurement comes about essentially is they're measured in looking at leadership, planning, problem solving, communication and management, and then there's an overall rating and score. There's two parts of compensation. So one part is what is already negotiated in a standard change in compensation that's through the city. And we have the ability to make changes to compensation based upon the range that's set out there. This is more specifically merit-based, and it's on top of that negotiated compensation raise. So in our review, I have to say that there were a few things, starting with Roberto first, that I think were pretty significant during the last year. Number one was, and Drew's commented on this numerous times as chair of the audit committee, was the completion of the pension administration system.
Go, Barbara.
So Barbara led the process. Roberto worked closely with her in implementing that. And it was impressed upon me numerous times when Drew said, look, Silicon Valley, this is one of the hardest things to get done. It is a major undertaking, and it was done successfully by our system. And in our review that we had with the Federated Chair, Matt Lowe, she commented on the fact that, look, we need to be talking about this in the city, and they understand how significant this was and how successful it was. So that's one thing. The second thing is we do have Barbara sitting here, and Barbara replaced a long-term employee that we had. Roberto led the process of that search, and it's always a little anxiety-producing when you lose somebody at the high level within the organization, and I think the transition's gone very smoothly, and everyone's thrilled to have Barbara in her seat. We also had to deal with, well, not on our side, but on the Fed side, the overpayment. We had previously dealt with that successfully. Comments in the review that Fed dealt with that successfully over the last year. And I just want to point out that I think we're very fortunate to have a CEO that's been with us this long. I don't know what the typical tenure is of a CEO or director. Harvey probably has more knowledge of that with the other systems he's worked with, but come February of next year, it will be 7 years that Roberto will have been with us, and so we're very fortunate. There are some things that we'd like to see as we move forward. We've talked about the website, and we really want to have that upgraded and increased communications to stakeholders. Succession planning will continue to be an issue for the organization, so we need to focus on that. And I feel like we've spent a tremendous amount of time on the investment side of the overall Office of Retirement Services. We want to have a little bit more discussion going forward and transparency around operations. Are we operating efficiently? Are we retaining employees? Are those employees satisfied? Are things running smoothly? Are members being served in the manner that they should be served? So that'll be a bit more of a focus for us. But overall, it was a positive review, and we come to now making a recommendation on what that compensation level would be. So here's what's interesting. we are using the city process. The city process, based upon that, gives you typically what that would look like in terms of an increase in compensation and vacation days. But yet, we're not necessarily bound by that, as we have some latitude in compensating our CIO as long as we're within the range. A standard increase in compensation would be in the range of 2 to 2.5%. And when we move beyond that, I believe we need the Office of Retirement Services to potentially bless that, or at least acknowledge that. At the same time, we need to work in tandem with the Fed Board, and the Fed Board has not completed their public review. So whatever we're talking about here, we need to coordinate with Fed. But I'm going to make a proposal here today, and I'd like to have some discussion around this. Whatever we decide upon, then it will move to Fed, and if they concur, we move forward. If not, then we need to have further discussion. But I think we're fortunate to have someone have been with us as long as they have been. I will tell you, having been chair of the Joint Personnel Committee, we did a survey 2 years ago, August 2007, by Coffin Associates, and we looked at the range of salaries and where the median is and the average is for peers, and we still have a ways to go to get there. And I'm going to propose that we increase and provide a merit compensation increase of 3%. That would be in addition to what he receives already from the city, which I believe is going to be a 3% pensionable contribution next year.
That's the cost of living, yeah, I don't know what you call
Okay.
that. But, yes.
So that's what I am proposing. I'm looking now for some further discussion on the reviews, what I'm proposing in compensation, and if you would like to see something different than that.
I agree with the assessment that was established by both boards, police and federated. My experience in the last 4 years has been very satisfied with our interactions and how he has run retirement services, his interactions with all the trustees, and the responsiveness to any questions that we have. I also believe that, we are very fortunate for him to have him for the last 7 years. And I would hope he would be around for another 7 years, because I believe things have been running very smoothly. It takes a lot to keep the ship going, and he is a constant person who has always made great decisions. I think he's been a great communicator. I do support the 3% performance increase. I would like to, I am not familiar with the numbers off the top of my head, the 2017 evaluation that was done, the survey. I would hope that we could, in the next 6 months between now and the next, before the fiscal year ends, that we take a look at that as a board and see just to reevaluate it, to see where we are at on that scale. And if we are not in alignment, then we should have another further conversation about that. But I completely support the recommendation.
So let me jump in, Vince. I think your words were well spoken and very wise. I think it's the best general is the one whose troops never fired a shot because they were well armed and well trained and the enemy knew it. The best fireman is someone who never had to go to a funeral because he made sure the smoke detectors were right and his crews and trucks were correct. The best doctor is one who tells you to take your tests and make sure you follow up. And that's Roberto as our CEO. It's something I say about a duck, it's all calm above the water, and the web feet are frantically paddling under, making the thing go. Roberto, I think you do an excellent job of bringing levity to what you do and making it seem easy, but I know how hard what you do is. I think you're right, Vince, we should brag. As how many times have we complimented Barbara? Part of my reason in doing that is to send a message to Roberto and to Barbara and everybody else. We know what a great job you did, and I think we should toot our horn in this. So I'm 100% supportive, Vince, of 3+3.
Just to echo what everybody's saying, from my perspective as a participant in the plan, what I expect of Roberto is to make sure that my members, fire members, are taken care of, and I think he's doing an excellent job. But to just alter what Andrew said a little bit, evaluating a survey from 2017 is obsolete. I would suggest that we do a new survey and take a look at where people are being compensated now, because we could be even further behind based on what should be going on. So it'd be my recommendation that we look at doing a new survey.
Good. And currently, I'm chair of joint personnel. Doing that, in addition to chairing the board, is a little overwhelming, and I know that we've struggled at times to keep meetings going forward and coordinating those meetings with Fed as well. The fact that I'll be turning over board chairmanship to Andrew will allow me more time on joint personnel to really focus on that. So, good suggestion. I think we can align the work that needs to be done in meeting the civil grand jury's request of identifying proper metrics, going back and updating the survey, and then when we come to the CIO, I want to talk more about incentives as well and how we think about that. The other thing I want to comment on here as well is that I don't think that most CEOs or CIOs, I know they don't, struggle with the fact that they have to serve 2 boards, 2 plans. It's extremely challenging. It's an increased burden of work. And specifically in relation to Roberto, I know there are differences of views of how the board would like him to operate. For us, he operates really kind of in the direction that we've guided him. We've had comments at times where, Roberto, we want you to speak up more, we want you to speak up less. And he's found that right path, and I think it moves very successfully for us. On the Fed side, in part of the reviews, they have newer trustees, and they are just trying to figure that piece out and what their expectations are for the CEO. That's a tough, tough thing to navigate, and I think Roberto does a good job in managing that. In addition to the 3%, there are the executive days, and I want to grant 5 executive days as well. So that is going to be my motion.
Second.
Okay. Any further discussion?
Yeah, Ben,
Yes.
just briefly. For those of us that have been on the board for a while, there was a time, not that long ago, when this was a board divided. We've made tremendous strides the last 7 to 10 years, and it really started around the time that Roberto came on board. And it's continued. We've hit some home runs with the investment trustees that we've brought on board, including Gia. But we're lucky at this point, and hopefully moving forward with Barbara and then with Prabhu, we continue to continue down this road of stability. But I would just like to say that I agree with the comments that you and others have made today, and I would support your comments as well.
Right. Okay. All in favor of the motion?
Aye.
Any opposed? Okay, motion carries. Moving on to our CIO. This is tricky. This is tricky in the sense that we have a CIO who is evaluated by both boards in an outstanding manner. The comments and the reviews that were done, and they were done both, again, by both boards and commenting, and then the review that took place with the CEO and the chairs of the investment committee. I'm going to just read off some of the comments and observations on leadership. Outstanding. Has a vision for the plan and his team. Provides great structure to strategic discussions and options. proactively engages on the fee issue in a calm and patient in explaining fees to city council. Exceeded our expectations. Great job taking over leadership, overhauling the investment policy with the ad hoc committee. That was a significant undertaking that took place during the year, early on, and then adopting a new strategic asset allocation. Planning, discussion in much detail as a standalone category. The Fed board gives the CIO very high marks for anticipating issues, organizing long-term projects, developing the venture program. Problem solving, outstanding. Among the CIO's strength, this may be the foremost. Good at creating options for the board to consider. Communication, exceptional communicator, very intelligent, mindful of all constituents, communicates a calm and patient manner. I mean, I can go on and on here, but the reviews are very positive. And we're very fortunate to have a CEO of the caliber that we have with Prabhu. If Prabhu were in the private sector, he would be earning considerably more. We're in the public sector. We don't have the ability to pay those levels. And I'm not going to suggest that we try and compete with the private sector. But what I do think we need to seriously think about, partly today as we discuss this, but more importantly in the work on the Joint Personnel Committee, is how is it that we're going to continue to retain the outstanding team that we have on the investment side? And now, how are we going to start to measure specifically investment results so that if we have the ability to create an incentive compensation, it's fair and equitable, and that there are measurable ways of evaluating the performance versus benchmarks. So if additional compensation is granted, it can be easily justified to all stakeholders. We're not there on that piece yet, unfortunately. So that puts us a little bit in a box. One of the things that I know I had expected, and some of you may have expected, is with a new CIO coming in, and actually an interim CIO applying for the position and not getting it, that we may have had turnover in that department. We didn't lose a single person. And in fact, he's actually recruited some really good talent. So I'm thrilled that we have Prabhu. I don't have the checkbook to just pay him whatever I would like to pay him, and nor do I think that it would be easily acceptable by stakeholders. So I want us to approach this in a very thoughtful manner. With his outstanding review, that would typically give him a 2.5% increase on top of the city's agreement is. To me, I can't stomach that. That's too small. That doesn't reflect the work, the body of work he's done in the short time frame that he's been here. At the same time frame, I think until we have truly measurable results showing that San Jose is not one of the poorer performing plans, we can't just look at it relative to peers, but overall, until we have that data, I'm not ready to say we should be paying our CEO at the very top of the range. So at this point, he's somewhere in the middle of the range, and I think that's unfair. I think he should be moved higher up. I'm going to recommend a 5% increase in compensation for our CIO. Those are my thoughts. Gia, I'm going to actually turn to you next if you have any comments, since you actually sat in on the review, and Roberto as well, if you'd like to comment, and then Andrew, and we'll go from there.
Right, I'm not going to regurgitate exactly what you said, but maybe I think we're all appreciative of where you've brought the investment plan to where it is now, and we believe that 2020 and beyond we're really just executing the plan, and hopefully we generate the alpha that justifies the team going forward. In terms of compensation, we really haven't gotten into deep discussions into that. But I would agree with the 5%. I think there are, several tiers to consider in terms of how we're compensating our talent, and at the very least, we should be at, kind of the median, right? And I think we need to make sure that we're at least at that. The JPC probably needs to make those decisions in concert with the board. I think I see 3 tiers. There's the city range, salary range, and then there is the broader kind of California pension plan averages, right? And then the 3rd tier is the private, and whether we decide to put that aside for the time being, those 2 tiers of the California plans and the ranges within San Jose, we need to make sure that our talent is at a minimum at that median, so that we're not at risk of losing some of the great talent. And I think your 5% gets us, moves us towards that, or even slightly above. That's a step in the right direction.
Okay.
And I believe it does.
Okay.
You know, I think everybody's going to highly praise Prabu, and no surprise either to Prabu. So I'm very comfortable on this, whatever the chair of the board, the chair of the investment committee, of course, the CEO thinks. So Roberto, why don't you weigh in and tell us what you think?
Prabhu, I'm going to speak about you now. No, let me just say this. We are extremely lucky to have someone of the experience and the knowledge of the markets, someone as Prabhu. You know, we are not just very lucky, but we're excited to have him on board. And I remember through the process when we are selecting the CEO, CIO, one of the issues that I remember telling both boards was that I thought he was going to be able to work with the staff and provide the kind of support and training that is needed to make sure that staff wants to remain at the office and get the kind of experience from someone that of the experience of Prabhu in the financial markets. And he has done an excellent job. He's well deserved for everything that the board has said and will be providing. And I just want to say thank you for the hard work, and I'm hoping that we can continue working together for many years. I have tried to ask him to tell me how many more years he wants to work, and he never tells me an actual number. So I keep thinking that may be positive, but I'm not sure. So, but nevertheless. An excellent CIO, a great manager. I know staff love to work with him and for him, and so I support 100% not only all the words, but also the request of a 5% increase. And I think it is important that both boards work in tangent on making sure that whatever final compensation structure, or whether there's an incentive portion of that compensation is at some point approved, that is well designed, so that we can not only attract the right kind of skill set that we need, but also that we can keep them employed for enough years to really make a difference in the plan. So.
I'm not going to add to what everybody's saying. I completely agree 100% with what everybody's saying about Prabhu's performance over the last, since he's been here. So it's been about 20 months now. The body of work and the amount of work that he has accomplished in the last 20 months is pretty impressive. Equally, just as impressive is the ability to retain his staff and to recruit excellent people. To add on to what Franco's recommendation was, I do believe we need to reevaluate, and figure out different metrics, for Prabhu and investment staff. Something that I think JPC should make a high priority. If we're going to do a survey for the CEO, we might want to consider doing one for the CIO at the same time.
Great.
I'll move that we approve the unanimous joint recommendation of the chairman of the board, the chairman of the investment committee, and the CEO of the plan.
Okay. I did not grant the days yet. I need to do that
Okay.
as well.
Oh, sorry, go ahead.
Let me add that. I would grant the same executive days that we've granted the CEO, which is 5 days as well.
I'll amend my motion to include that.
Okay,
I'll second it.
all right. Any further discussion? I'll just add during the discussion phase that, Roberto, you can probably tell us exactly what the time frame is, because I know it was a fairly lengthy time frame between the previous CIO and Prabhu coming on. The impact to the plan by not having a CIO and having to go through the painful process of recruiting and searching, the cost to the plan can be tenfold what we might be, tenfold's a very low number, actually. It's considerably greater than that when we're talking about combined $5.2 billion that's being directed by a CIO in the vacancy. Do you recall how long it was? Was it 12 or 18 months that we had that vacancy?
I like to, you joined us in March of 2018?
That's right.
So I think it was a full year. I think that the prior CIO may have left around the spring of 2017, and you joined us, so close to a year.
Yeah. So that's critical that if we have talent, we try and retain that talent. So thank you for the motion, and the second, who seconded it?
I
You
did.
seconded it? Okay. So motion by trustee Alonso, second by trustee Vice Chair Gardner. All in favor?
Aye.
Any opposed? Okay. Motion carries with the note that we've got some work to do on joint personnel going forward. Let's take a quick 5-10-minute break, and then we'll come back and wrap up new business. So as we get ready to move on, our CIO asked if we can actually go back. He wants to completely renegotiate what we just said. No, I think he has some comments.
Thank you, Mr. Chairman. I just wanted to thank the boards for your review and for your support. I'm actually truly honored to be CIO of San Jose. I'm not saying this lightly. I told my wife, if I had an outstanding in every category, it just shows how low the expectations were. But besides the beneficiaries of the plan, the reason I'm here is because of all of you and your support. And I could mention all your names. We've had tremendous discussions. I meet one-on-one with our chair every month, just talking about venture with Drew. I mean, it's just the support and the involvement. And I want to say this publicly because our beneficiaries are truly lucky to have you all as board members. The amount of time and effort that you all spend. So, and that's a big reason why I'm here. Thank you.
All right, thank you.
If I don't say something now, you know, and let me tell you, I know Prabhu very well, but anyway, I mean, the one thing I'm going to say, first of all, thank you for your support. You're correct. February is going to be 7 years. It's been really a pleasure and an honor to work with both boards over the last 7 years, and I strongly believe part of the reason is because of the strong support by both boards. But I'm just going to, I'm not going to echo everything that Prabhu said is so true, only to say I have more than 20 years experience working with boards during my career in the public arena. And I can tell you that half the battle is actually being engaged and committed. And I can let counsel speak to it, but those are his clients, so he may not speak to it. That's not always easy. And I cannot say enough about the engagement and the commitment by both boards trustees. We don't always agree, but I will never, ever question everyone's engagement and commitment to the plan. So for that, and for the members, we thank you. And again, thank you for your support.
Okay. Thank you both. It's good that you said it after we agreed, so it doesn't look like it was a setup or anything. 4A, oral update from our CEO.
Yeah, thank you, Mr. Chair. So if you bear with me, I have a few comments, and then I'm going to ask Cheryl Parkman. You can see her sitting at the audience. She cannot wait to speak up. She's been wanting to talk to you. In fact, she misses every time she leaves a board meeting from Police and Fire. She can't wait to come back. A couple of issues. So first of all, there was an election for the fire active member, and Andrew actually was reelected. Congratulations, Andrew, to be the employee representative. He's still here with us, and we are very excited to have him. He will be reappointed by the City Council at the next meeting on December 10th, and obviously before the January meeting, then you will have to take your swearing.
Sworn oath,
Yeah, thank you, oath and everything else. But congratulations, Andrew. We look forward to working with you. And again, next year, for the new decade, you're going to be our new chair. I also wanted to mention, you may recall, we have spoken about the Retirement Solutions Working Group that was called for by the mayor during his budget comments last March. The first meeting took place November 12th, and Prabhu and I both have presentations. It was really funny because one of the comments about Prabhu's review, which is completely true, he's very German,
Jermaine?
no, he's also Jermaine, but he's a gentleman-like and very calm, and that's true. And so we both presented, and there I was, hyper, talking really loud, fast, slight accent, and then it was Prabhu's turn, very calm, quiet, composed, you know, and so whatever. But anyway, so we both have presentations. I thought they went very well. I spoke, provided some background on both plans, actuarial information, just to sort of let the working group know where both plans are at this point. And Prabhu spoke obviously about the investment program. And the next meeting actually is taking place this coming Monday, December 9th. And you should know that from your Police and Fire Board, your chair, Vince Inseri, and who else am I missing? Gia Griarte is also a member of that working group, although Gia is coming off December 31st, but you should know those meetings are public, so you're welcome to attend the meetings in any case. I also wanted to let you know that our 5-year lease agreement for the building is coming up on spring 2020. And I work with Dinesh, who did excellent work. We look at some locations, and you know, I also had in the group discussing that Prabhu on one hand and Barbara on the other one, which, you know, it was very good because they were sort of balancing acts for me as to what to decide. We have decided to remain in our building, but we have requested some improvements that they're going to be working on in the near future. And as soon as we worked out the lease agreement, we will share that with you, so you know. But we are looking to sign for another 5 years, and we will remain at 1737 North First Street. It was mentioned during my review. The staff is working on the first edition of the newsletter. It's coming out mid-January, and we're going to issue a newsletter on a quarterly basis. So be on the lookout for your meeting in January. You will have a copy of the newsletter under your communications. In addition to that, the second part of the year, when I said the year, I refer to the fiscal year. We are going to be working on revamping. I'm not sure that it's going to be completed by June 30th, but revamping the website. And lastly, I do want to mention that we are working with a communication consultant, and one of the goals is to bring the communication consultant to speak to both boards in the spring and come forward with a communication plan that would include how to use social media as part of the communication plan. Finally, I mentioned at the last meeting that we had just hired a new benefit analyst that came from the private, and unfortunately she was with us for 2 weeks, but her former employer was able to bring her back with an increase in pay, and so we lost her already. So we will have to do that search again. Lastly, I wanted to mention that we are going to embark in a legal RFP, and that is for all the legal services, that means general counsel, fiduciary counsel, tax counsel, investment counsel, and domestic relations and disability counsel. The last RFP that our office issued for legal work was 2011. All legal contracts expire on June 30th. So we are hoping to actually issue the RFP or complete it later this month, to be issued, to run for a full month until sometime in January 2020. And proposals will be requested back late February, early March. We're hoping then to have interviews and bring to you board forward some recommendations to make final selections by May 2020, so that we can have contracts set up and completion June 2020, and in line with the June 30th, 2020 deadline. That concludes my comments, Mr. Chair. I'm happy to answer any questions. And if you allow me, I'm going to ask Sheriff Parkman from 1ER to comment to you on 3 items: the status of the CalPERS benefit for the investment professionals, the status of the medical panel RFP that was issued by the city, and as part of the working group, the city is hoping that at some point both Mikita and, to some extent, Chiron can actually come forward to the working group and present, and I believe that Cheryl has some comments and requests on that as well.
Thank you, Roberto. Cheryl Parkman, Office of Employee Relations. I'll start with the update on the CalPERS benefit. We have been in contact with CalPERS requesting an update every week. What they've told us is that they are awaiting final approval on the contract amendment. So I've been told that there should be a meeting next week, and we're hoping to get it then. I have been continuing to basically bug them until they give us an answer, so I will continue to do that. I know that it is of extreme importance to this board that that is done as quickly as possible, and I can assure you that we are working on doing so. I'll move on to disability, if there are no questions on CalPERS. So as the board knows, we did issue an RFP for an independent medical panel, or for qualified physicians. That ended on November 29th, and we did not receive any bids. So at this point, there will be kind of next steps. I need to make sure that we inform our principals, which would be the city council of that also new development, and then we'll be coming back to the board with any other changes that may need to come with that, or any other updates of what we need to do. Yes, Andrew.
So is the plan then to update city council and get their guidance on where to go from there? Or is it going back to the unions to talk about what can we do?
I think the first step is we need to ensure that the city council is aware of this this new development, just because it is a part of our negotiated settlement framework over pension reform, and then we'll move forward with next steps, and we'll make sure to not only inform the boards, but the bargaining units of what those next steps need to do, or what they need to look like.
Right.
Did you have feedback as to why there were no, any bids?
We did not receive any sort of questions or feedback as to why this didn't have any sort of bids for it. So at this point, we're unaware. This was, I believe, the 3rd attempt for the city in total to go out for this RFP. So it just may be that there were not any interested parties based on the scope of work produced in the RFP.
Scope and compensation.
That, we did not receive any feedback on it. That is we can speculate on that.
All right. I mean, because we need to kind of know how to move forward, right? To address why there is no interest.
Right.
Can I ask a follow-up question about that? How far do we reach? How do we send out the word for this RFP? How do we request input?
So through the city's bid sync program, so we have a vendor that we use for RFPs, and that system allows us to market or communicate to basically a set list. So we We chose any sort of qualified physician or medical group, and so that basically sends the word out nationwide to any particular parties that may be of interest. Here at the city, we also have a division manager in health and safety who actually comes to us from the private sector and has extensive knowledge of workers' comp and the qualified physicians in that arena. We did ask him to promote this RFP to his contact base, which he did. So we can also know that there was some local and some national attention that was given to this RFP, and unfortunately, there were no responses provided.
So if I'm a physician who might be interested in this, but I don't access BidSync, because I think that's a limited tool, how would I know about this if I'm not connected to the network, the other network? Is there any bigger way that we can advertise this?
So we do rely kind of on word of mouth from our stakeholders that know about the RFP and can push that marketing information out there, whether it's our employees, our bargaining units, or the staff here at the city. So if you're a physician that isn't included in that kind of network or sphere of knowledge, of interpersonal knowledge, then you might not know that this RFP is out there.
Okay. Thank you.
Oh, you're welcome.
Just for this board, we've heard it from Donna. We knew it when we negotiated it. The criteria to be qualified for this position is very, very restrictive. So you're not likely to get anyone that would normally do this kind of work to bid because they're almost automatically disqualified. I think as it sits right now, the way the criteria is, Dr. Tierman would not even be allowed to be on that board.
Yes, you would absolutely.
So that's just to give you the idea of the restrictions that are put for someone to put into that position. So ultimately, I believe that we'll probably be back at the table discussing this again.
We have to bargain it.
This is like the third or fourth time we've gone with the bid.
Got
So
it.
now we know, we got the feedback, we just, you guys need to tweak it.
Got it, okay. Thank you.
Okay.
And the third item I was asked to talk about is the Retirement Stakeholder Solutions Working Group. So at our last working group meeting, we did ask for future agenda items, and we went back to the mayor's March budget message to see which of those items had previously come up, and there were a couple questions maybe about the discount rate. So we had a couple questions about the discount rate, amortization schedules. So us not being the experts on those particular things, we've come to ask the boards if it would be possible to use the services of Chiron, particularly for a discussion around amortization schedules. Now, I can't come to you with a very narrowed scope because we haven't had that discussion at the working group, but we wanted to pose that question to the board to see if the boards would be willing to let us use Chiron services for the Retirement Stakeholder Solutions working group. At the next meeting, we will try to narrow that scope so we know exactly what Chiron will be producing for that group, just so it can be for informational purposes only and educational purposes, not for any sort of choice or recommendations in what would be provided to the board.
Cost, where would the cost come from? Who would be
So
paying
that's
for it?
something that we would need to discuss based on what the total costs are going to be from Chiron, to see if it's something that, the city could potentially pay for a portion of.
Okay.
I would not only support it, but I would encourage it. That way, the stakeholders get to hear the same type of information that the board is hearing. But in addition to Chiron, I think it would be valuable for us to also seek out to another party, because it might be valuable to hear possibly other ways of looking at things that both our board hasn't heard, that might be different than how Chiron looks at things. It may not necessarily be an actuarial firm, maybe it's somebody in the world of academia, just something to consider. And I obviously didn't mention this at the meeting, but going forward, that would be the type of thing I think would be valuable, both so the stakeholders can hear the same type of information that we're hearing that helps us make decisions, but then new and alternative information as well.
And an idea with the working group is that the working group really should be the ones producing the ideas for the content that they would like to hear. So it's not just OER producing what we think you guys want to hear. So I believe that that's a great suggestion. And so we are going to have an item for proposed agenda topics. And I think along with that would be with proposed presenters or experts to come in and talk about different items. So I believe that this is something that should be raised by the members of this board on the working group on Monday.
So is that going to be on the agenda on Monday?
That's correct. And the
Okay,
agenda, we're just tweaking a couple things in a couple presentations, but for those members, it should be going out to you by the end of day tomorrow.
Okay, all right.
No, I just wanted to mention, and quite honestly, that these are public meetings, so if any of the board members really want to participate in discussions as a public member, not as a member of the working group, they're always welcome to attend. The meeting is actually right now scheduled for 4 o'clock right here, right where we are today. No lunch or anything, but certainly we'll be here.
It's from 4 to 6, and I'm sorry, we will not be providing dinner.
Other feedback on this?
I was just going
Yeah.
to echo your comments, Vince, about the Chiron report. That does create, as a member of the working group, that does create some consistency in what we're looking at here and then what the working group would look at. But I also like the opportunity to see what someone else recommends or someone else another organization or person is thinking we might be considering and looking at. I think that would be helpful. Our job is to think out of the box a little bit and come up with different ideas, potentially.
Yeah. Good. Council?
Thank you, Mr. Chairman. Just a couple of suggested parameters, maybe, if the board's going to approve Chiron to do this. First of all, cost. It would seem that assisting the mayor's working group is not a core expense of administering this plan, so we really ought to talk about the cost being borne by the city, not by the plan. The other thing is that I think if Chiron's asked to provide a general education about how all things actuarial work for a defined benefit plan, that's fine, or in historical information about police and fire or federated as well, in terms of here's what it is, here's how the process works in front of the board, that's fine. I have a bit of a concern, however, if Chiron is enlisted to to talk about proposals or alchemy in terms of other approaches to funding and start running some if-then scenarios, that sort of thing, at the request of the board. I've seen situations in other states, for example, where the actuaries for the pension board have essentially, for lack of a better word, been co-opted by governor's task forces and things and enlisted to support, which may or may not be, it may be getting out ahead of the board. That is their primary obligation and their primary responsibility. So a bit of a caveat that we really ought to work on the scope of what's being asked. If it's a general education and how our particular systems work, I think that's fine. If it goes beyond that in terms of assisting the promotion of proposals that relate to the funding of the plan, I think that's where we would want to revisit it with the board.
That's excellent advice. Thank you.
Can I weigh in about the cost too? I agree that it shouldn't be borne by this body at all. If it's the council this is a council working group, that fee should be paid by city council and by the city. It shouldn't be borne by us. I just wanted to weigh in on that too.
All right. Good. Any other comments?
Thank you so much. We appreciate it.
Thank you.
Cheryl. I do have a Gia.
This is related to the CEO's comments. You mentioned that you're going to go out for RFP, right?
Yes.
For the
services?
council, yeah. That's going to be for each of the different areas, right? You're going to have different councils RFP for each different areas, right?
That is correct, yes.
Okay.
It depends on how the RFP is developed. I'm sure Benji is back in the office watching this and listening, so you can certainly text me. But we would expect to have different kind of legal services that specializes on the areas, but that's not to say that we cannot have one particular firm that provides 2 or 3 of the services. So it depends how the RFP is actually drafted and what we're looking for. As it stands right now, we do have 4 different firms providing all 4 different services.
Right, and to that point, I would recommend, I mean, I know that I'm rolling off, you guys can make the decision at that time, but, you know, each council has their own areas of expertise.
Yes, absolutely.
And having one broad consultant to handle all of that, I would be very concerned. And I think you should really make sure that you're optimizing for each of that particular area.
We will certainly get on. I mean, I would expect that will be
Yeah.
the case, but again, I just want to make sure how the RFP is
Right.
drafted, and we would expect firms to bid on either as a whole or in specific areas of expertise. You are correct on that.
Okay.
And
Thank you.
staying with that same theme, I was going to ask about fiduciary counsel to the boards. I know that last go-around, we actually had trustees involved in the interview process. I don't know at what stage they were involved, but I would assume that we would have similar engagement as well. Is that correct?
I apologize, Chair, because I was actually looking at a comment by my staff that I forgot to update you on one issue, so I didn't.
It's okay.
I didn't hear everything you said. I apologize.
I was saying that the last time we went through this RFP process, the board was very engaged in interviewing the candidates for the fiduciary counsel position, and I would assume that we'd have the same
Yes.
process going
Yes,
forward.
absolutely.
Okay.
Yes. But I do, and I thank you, staff, for reminding me. As you know, GIA is running off the board on December 31st, and the city clerk actually opened the application process for public members. And unfortunately, the process actually ended, and if I'm mistaken, Linda, please correct me, but we did not receive any applicants. So we requested from the city clerk to extend the timeline. So right now, I'm not quite sure whether the timeline has already been extended or it will be extended again. Has been extended to December 31st in the hopes that we can get an applicant. And I want to mention, and this is very important, we did follow both of the board's direction to staff on our engagement to make sure that we reach out to bargaining units, academia, and different areas, providing the information and the application. And so even with that reach out, we still did not receive any applicants. So at this point, we don't have, in case you change your mind and want to stay a little longer, we do not have a new applicant, and we're hoping that with the new timeline through December 31st, we receive a couple of applications. Thank you for the reminder, Linda, I appreciate it.
Okay. Move on to 4B, oral update from city council liaison to the board.
Thank you. You already heard about the working group, so I don't need to go into any more detail about that. Just recently, though, at the last city council meeting, we approved putting a ballot measure that will appear on the ballot in March that deals with transfer taxes. The transfer tax will be triggered by a sale of $2 million, and it will be stepped up. So the median price range in San Jose is around $1 million plus. The transfer tax occurs on the sale of a property, and this will generate general funds that, because it's general funds, we can't be specific on how we're going to be spending them now. But the idea is that we might be able to use these funds for homeless concerns, for affordable housing, and to build additional housing and solve some of our housing needs of our population that is really at risk, including additional services in that. So that'll be on the ballot. It triggers are at $2 million, and then $5 million, the cost of the transfer tax goes up. There is a cost of living index that we'll be looking at every 3 years to make sure when the median price hits $2 million, which it's sadly to say it might hit, we don't want that to trigger the transfer tax at that point. So there are triggers that allow us in years ahead to look forward to increasing the threshold on the median price range. That's the big item that we approved the other day.
Interesting. Any questions?
And because it's going to the ballot, you'll all have an opportunity to vote on it if you live in the city of Santa Fe. March, sorry.
Okay. Any questions?
What is the tax?
The transfer tax, it's, good question. I don't have the details. It increases, it's currently $3.30 per thousand on the sale of a property.
Okay.
That'll be the same up until 2 million, and then I think it goes, it's an additional $6.60, but I could be wrong.
The rough numbers.
Yeah. It should generate approximately $70 million. It's all tied to transfers of property. Commercial as well.
Interesting. Okay. Well, y'all get a chance at the ballots to voice
You can,
where you stand.
Yep.
4C, discussion action on the June 30 pension actuarial evaluation results with alternative amortization adjustment scenarios. This is a carryover from last month. And actually, hopefully you had a chance to dive into this, because this is really interesting, the work that they did, the impact to contributions to the unfunded liability. So I'm looking forward to really some robust discussion as we consider making any potential changes here.
Thank you. Bill Hallmark and Ian Harper with Chiron. This presentation is titled Final Valuation Results. Normally, when we present the final valuation results, we also provide you a final valuation report. The reason we are not providing a final valuation report is, although the results are final, as the chair alluded to, there is a decision for the board to make about how we amortize it. And we've put those options in the presentation, and in the appendix, there's 5-year projections for the city's budget based on the alternatives. And assuming the board elects one of those alternatives, we will just provide a report for the next month's meeting without a presentation, because it'll just memorialize the decision you make today. So having said that, we're going to start with our normal presentation of the valuation results and the contributions and so forth based on the initial proposal for the amortization adjustments. And then we'll end with the alternatives, and you can look at the actual impacts on contributions of them. But those choices don't affect the measure of the liability or the normal cost or any of that. So we thought we'd go through that and get that out of the way beforehand. As we start this presentation every year, we go back to this diagram, the basic diagram for the pension system. And just as a reminder that over the long term, we have to have the contributions plus the investment earnings equal the benefits and the expenses paid from the system. What we do in the valuation is we take the census data and the assumptions that you approved at the last board meeting. We estimate what those benefit payments are going to be in the future. We look at the size of the assets and our measure of how much assets we should have on hand, and based on estimates of investment earnings. And the real rub of the valuation report is to decide how to turn those valves on the left-hand side in the diagram for employer and employee contributions. Now, the statutes dictate how it gets split between employer and employee, but so we're really talking about what's the total contribution we need to go into the system. So at a very high level, in the current fiscal year, which was based on the last valuation, the contributions from the city were 82.6% of pay, and from members 11.9%. We would see a slight increase to both, to members at 12.2% and to the city at 86.1% of pay. The red line that we're showing there is the normal cost. That's the cost of the benefits attributable to the current year of service. So that's the new benefits that are being recognized. So all the contributions up to that red line are paying for the new benefits. The blue line represents the additional cost for the interest on the unfunded liability. And so we call that the treadwater line, because all the contributions up to that blue line are just so that the unfunded liability stays the same dollar amount if all of our assumptions are met. So it's only the contributions above that blue line that are actually going to reduce your unfunded liability. And this plan actually has significant contributions above that blue line. There was a study I was an advisor on by the Society of Actuaries that looked at this, and only 40% of plans nationally are above the blue line. So 40%. So, and Federated has just gotten above the blue line. It's been a long process to get there. But so this plan, we're contributing significantly above that blue line. It's about 26% of payroll, is that right? That is going to actually reduce the unfunded liability. And you'll see that in some of our charts historically, that we've been consistently taking a slice out of the unfunded liability with contributions.
I'm having a hard time making the connection of what's causing the trend line to go down. I know that's a good thing, but what factor is attributing to that?
Good question.
There's a couple different things. It's actually a complicated picture this year. And we'll get into some of it. Part of it is the overall payroll increased, and so you get a bigger dollar contribution for the same percent of pay.
Okay.
It's also just moving the amortizations and stuff a year forward. And so we're making progress. We expect that line to go down further in the future, just with our growth in pay and our paying off the unfunded liability.
Thanks.
At what point do we look at this in separate tiers, tier 1, tier 2? Because if
We
you-
have that broken out here. We'll get into some of it now. This is to give you the 30,000-foot level view of the system.
All right. But in general, if you excluded tier 2, that line wouldn't be declining the way it is.
Tier 2 has very little unfunded
Correct.
liability. So
But you're adding their
you're
payroll into
basically-
the mix.
But we are adding their payroll in, yes.
Okay.
The right-hand side shows the measure of the liability in the bars, the actuarial liability. The blue bars are the portion for people who are currently receiving benefits. The gold bars that are unlabeled are for people who are no longer working for the city but are entitled to a benefit in the future, the deferred vested benefits. And then the red bars are the active liability. So you can see a very substantial portion of the liability of the system is for people who are currently receiving benefits. The lines represent the market value of assets and the actuarial value of assets. The actuarial value smooths gains and losses over a 5-year period. So it will typically stay fairly close to the market value, but move above and below it depending on market volatility. They're both very close right now. And then at the top, we are showing the funded status based on the actuarial value, which actually did decline this last year. And we'll talk about what's causing that as well.
If I stick with that same line of questioning about separating tier 1 and tier 2, would that mean that if you looked at just tier 1, the funded ratio has gone down even more dramatically for tier 1?
No, it's pretty much, you're pretty much looking at tier 1.
You are, okay, got it, all right. Thank you.
So just to look at those steps and what happened and what's changing, both the city contribution rate and the city amounts. For the current fiscal year, the rate was 82.6, which translated to about 186 million. Based on the last valuation, our projection for the 2021 fiscal year was that it would increase to 85.4% and about 199 million. That increase is largely because we have investment losses that we haven't fully recognized. And so in our 5-year smoothing of the assets, there's some movement each year where we're recognizing the prior year's investment gains or losses. And we had stored up losses, and so we expected an increase for this year. When we did the valuation reflecting the new census data, updated assets, but no changes in assumptions or methods or anything, we expected, or we had a contribution rate of 84.6%, and that was 206 million. So what's interesting here, and Ann, I think, shows some of this later, the rate went down, but the dollar amount went up. And that is because the payroll went up quite a bit more than we expected. And so we're collecting more dollars, and but it's a lower rate of pay. Then at last month's meeting, we adopted some assumption changes, and the method changes are the original proposal for the amortization changes are embedded in there. And that's what brought us up to 86.1% and 210 million as the contribution.
Bill,
So, yeah.
quick question. What's the balance of the deferred investment losses as of 2019? I mean, this is the number of investment losses that we have yet to be recognized, that we're going to be recognized in the next 5 years, right?
Yeah. Do we have that?
If you don't, that's fine.
We'll grab it.
Okay.
I
just want the board to know
I think it was in last month's presentation, because we had the actuarial value and the market value of assets on one slide.
Okay. Thanks.
So I'll proceed and, well, you looked that up, okay. So on this slide, we're showing the Tier 1, Tier 2 breakout. And you can see the left two bars are fiscal year 2020, and the right two are fiscal year 2021. And so largely the contributions are Tier 1. We're splitting this. The purple is the member contribution. The gold is that normal cost that the city pays, the city's portion of the normal cost. And then the red is the contribution toward the unfunded liability. So on Tier 2, the amounts are much smaller because the population is smaller. The benefits are smaller. They're split 50-50 between the members and the city. And there is a tiny, tiny sliver of a UAL payment there, but really not much of a UAL payment. For the Tier 1, the normal cost has remained fairly constant. What's changed is we've increased the UAL contribution by about $20 million. Now, I think in your version of the presentation, there was a typo that said 12 million instead of 20, but the chart was correct, 145 versus 125.
Oh, yes, it does say 12.
So I apologize for that, but the increase there that you're seeing is primarily an increase in the UAL payment for Tier 1.
So to answer your question about the deferred losses, There's $117,900,000 in deferred losses that will be recognized over the next 4 years.
Thank you.
$117,900,000
Thank you.
over 5 years, yes.
Yes. I always like to keep everyone apprised about that number because it does have an impact. Obviously, it depends on, which years,
timing,
obviously, some
yeah, gains
years.
and losses.
I don't, they're not evenly spread, obviously, so some years you're gonna have a larger impact than others, but that's something that needs to be taken into consideration.
Just to point out too, that those net deferred losses are included in the projections that we do.
Yes.
So just for clarification on that as well, that, yeah. And that number is we always put that number in the report too, what the deferred losses are, or gains.
Yes, understood. It just says, we don't have the report yet, I just wanted to
Right.
know the number. Yes, understood. Thank you very
Yes.
much for the explanation.
Can I ask a quick question?
Sure.
And that is updated every year based on performance?
So on this next slide, it breaks down the picture of the contributions that Bill was discussing earlier into the different groups, police and fire. And the top portion of the graph shows the member rates, the bottom are the city contributions. And the member rates from last year to this year did not move much, only about 1 or 2 basis points between police and fire. And as Bill pointed out, the city contributions, the main factor that impacted the contribution was the increase in the Tier 1 UAL. You see that the police UAL went up about 12 million, and then the fire went up about 8 million. So comparable to what the size of each of those groups are. The total normal cost for Tier 1, it was relatively stable for both police and fire, and then the Tier 2 contributions went up slightly for fire and a little bit more for police, from the 6 million to the 8 million, due to the fact that the payroll grew and there was about 6 or 7% increase in the active membership there as well. So overall, you have the increase in the contribution rate, or the contributions between police and fire, kind of it's consistent with what the total increases were for the plan. This graph shows the change in the UAL from last valuation to this valuation. The 2018 UAL was around 1.1 billion. The 2019 UAL increased by 182 million to about $1.3 billion. And the floating bars that are in the middle of those two blue bars are the sources of the change to the UAL. The contributions coming into the plan decreased the UAL by $50 million. So that $50 million represents the line above, or the space above the blue line that Bill was talking about earlier when he was showing what was being paid above the tread water level, and that's $50 million for the last plan year. Now, the increases to the UAL are investments was the primary source, and that's due to the investment return of about 3.4% on the market value for fiscal year ending 2019. The assumption changes increased the UAL by 80 million, and primarily due to the mortality assumption change. And then the liability experience increased the UAL by 35, primarily due to salaries increasing by more than expected. This chart is showing the change in the unfunded annually going back to 2010. The biggest driver of the change is the investment experience, and that accounts for about $760 million of the $888 million in change. And you can see that out of the last 10 years, we only had investment gains back in 2014 and 2015. And again, these are investment gains based on the actuarial value of assets. It's smoothed assets. This does not mean that you only achieved your return in 2 of those years. It's just, it's the return on the smooth value.
Just a quick question and a comment. As you are aware, especially Bill, I made a similar presentation and I had this slide at the working group. And a question was asked by the mayor, which I didn't have the answer right then and there, we know that the big 2 items that impact that were investment results and assumptions. How much of the investment results number was strictly related to the 2008-9? No, you don't have to answer that now, but I just want you to know, it will be helpful because when we go back to the working group, that will be, it's good information to have, right? Because, I mean, I would argue that downturn was not a typical downturn. And if I am well aware that it's the bulk of it, more than 50%, but I don't know what that number was, and I couldn't tell the mayor at the time, so it just will be helpful to have that number.
Yeah, and we can, we have in the past produced this showing the market value gain and loss by year so that you can see it on that basis. It does kind of blow the scales on our chart if you do that. But you can get a sense for it by just looking at the investment loss for 2010 through 2013.
Yes.
It's a very substantial portion of that loss, and that's taking into account part of the gains that we got in 11 and 12, if I remember correctly.
So if you can give us maybe a little bit further interpretation of this first line, the AVL gain or loss. So in 2010, that increase of almost $150 million, does that mean the plan's return for that year or the smooth return?
The smoothed return for that year. And so that is dominated by the 2009 loss, and 20% of that loss being recognized in 2010.
And that's compared to the discount rate for that year.
Yeah, compared to the discount rate for that year, but it also would have the gains from 2007 in it, right? So it's got 20% of the gains from 2007 that are mitigating the 20% loss from 2009, which is why Roberto's saying it's hard to disentangle to get, you know, the year-by-year market value piece.
Right.
And so, so we can give you that top line on a market value basis. It just adds a whole lot more volatility, and the contributions are based on the smooth value basis. So this tracks to those, to the impact on the contributions.
Yes, understood. Thank you.
Thank you.
So the next biggest source of the increase in the UAL, like you said, was the assumption changes. And those assumptions, or the main source is the lowering of the discount rate from 7.75 back in 2010 to 6.75 for this valuation. Now, it's been the 6.75 has been the same for the last 2 years, but that change over time. There were a couple assumption changes that had a big impact. One was the mortality assumption change that we did back in 2015. And then also, we did another update to mortality for this experience study, which also is part of that $574 million increase. So one last thing I wanted to point out on this chart is that contribution above the tread water level. That's at the bottom of the graph here, the chart here, and you can see back in 2014 it was about a $10 million was being paid off to the unfunded, and you can see how that rate, or that dollar amount, is increasing over time due to your amortization policy of paying more of the, you know, more than just the interest and the benefits accruing during the year.
Actually, can I add something?
Yes.
So I actually have the fiscal year returns for 2010, 11, and 12. just ballpark. So 2010, our return was better than the discount rate by about 6%. 2011, it was plus 11.4, and 2012, it was minus 10.8. So if 10 and 11 and 12 were a wash, 2010, we did better than the discount rate. So just that goes to show the magnitude of 2008 numbers. So that's a significant drag that was because of the downturn.
And just to make sure I'm understanding this, so the first row and the third row, the AVA gain loss and the assumptions, do they work in opposite direction, meaning that if you lower your assumption, meaning you lower the discount rate, right? So that means assumptions go up, but then it compensates in the other line. Maybe not perfectly, but.
Right, going forward,
Going
yes.
forward,
But there's a lot to those assumptions, it's not just.
Well, right, the main piece in the assumptions is the discount rate, except for the years that I pointed out in 2015 and 19. Those were more driven, they were driven by the demographic assumptions, and it was the mortality assumption there, yes. So just to touch a little bit on the plan maturity measures or benchmarks, the first being the support ratio. We saw the support ratio stay flat between 2018 and 19, and the support ratio, to remind you, is the ratio of inactive members to the active members. So currently there are about 1.5 inactive members for every active member. Actuaries like to split people up like that. So, and then relative to the other public systems from the public plan database, you're still in that top 25th percentile in terms of the support ratio, but it's stayed level this year.
So one of the reasons we're looking at the plan maturity is we brought this to your attention when we came on, because more mature plans are more sensitive to risk. Any changes cause a greater change in your contribution rate, all other things being equal. And what we saw right after 2009 was there was a significant increase in these maturity measures. And that correlated with declines in the active population, which you can see here. Prior to 2009, the active population was around 2,000. And we have not gotten back to that level. And so part of it is that, and then there were also the reductions in pay that came in 2011, which shows up in some of the other measures, which really reflects the city's revenue. Both of those reflect the city's revenue impact, which is the resource base to fund the plan. And so you've had a growth in the number of retirees and a decline in the number of actives that just makes you much more sensitive to risk. And so when you see these going forward, you'll see kind of that steep incline starting in 2009. The good news is we've leveled out, and you'll start seeing that these things have leveled out, and in some cases they're starting to nudge downward. And so that is a good sign showing that the growth of the system's recovered, but we still, compared to, Anne's showing you on the bottom, the national comparison, we're still really high on these measures nationally. Some of them were off the chart nationally. So it's still an issue, but it has really stabilized from that rapid increase following the recession.
Bill, can I rain on your parade a little bit? So me and Nick were talking about this at the break. And I've talked about this before, but in the next 4 to 5 years, from 2020 to 2025, you're going to see, and I know this is probably more on the police side, and you're seeing it today when we vote on retirements, there's 20 police officers leaving. We are looking about a third of our department that's going to be eligible to retire. And if you Google right now, crisis in law enforcement, you're going to see that law enforcement nationwide cannot hire. So what happens to all these numbers if we start going backwards again? How is that gonna affect us? Because that's really gonna be the problem. It is, and I know you on systems, he'll tell you, we cannot fill academies, and we're gonna have them flying out the door like this. So when you talk about that plan maturity, it's gonna probably start swinging back to what we were looking at before. Definitely something to think about as we talk about all this.
So let me stay with that, because it's kind of interesting, frankly. You've got about 1,200 that are currently Tier 1 active, so
Mhm.
you're talking about 400 that could be gone.
Yeah.
And I'm looking at the Tier 2 actives, which has gone from 0 in 2013 to 486.
Mhm.
Are you saying that you're not going to have the same ability to hire those 486 people over the next 5 years?
We're not, remember, we were running 3 academies a year, and we started filling them. We are now continuing with 3 academies a year and cannot fill them.
Ah.
So, and our attrition rate in the academies, because of lots of different factors, but one is when you have that crisis nationwide, it means everyone's struggling to hire, so it becomes extremely competitive. So you have other departments picking people, especially some of the smaller ones that pay and benefits are better. That's one problem. You've got a pool of people that go, well, I'll just decide to give this a run. They get into the academy, they get into the FTO, they fail out because they go, this is not what I thought it was. So we're seeing those we're not even able to retain. We're probably talking about 30 to, maybe 25 to 30% of the people that we're hiring do not make it through FTO. So it's just a problem. And you know, pick up the news, you got people, you got officers getting buckets dumped on them. I mean, who wants to go get that job right now?
Right.
So this is a nationwide problem, and it's gonna get worse, which is gonna make it difficult for our plan, because that in-pay status that you were talking about earlier, you're talking about those numbers, it's going up.
Right.
Thanks for the reality check.
Well,
No, I know, it's
we're making
helpful.
decisions on this plan and how we're
No,
gonna
no, no,
manage it.
it's-
Well, it's compounded by the mortality rate.
It's
too.
important.
Yeah.
The present ones are gonna live longer,
Mhm.
you have less paid in.
Yeah,
So,
right.
Yeah.
We've talked
Has there
about that
been
before.
You heard from Nikita that we're at record low unemployment. Is there historical correlation between high levels of employment in the private sector and hard to recruit
Yes.
people into academies?
Well, it is. So one of the things, we're recruiting in New York, for example. And when you look at a banner and you see that you can make double that here, and then they come here and they go, well, what does it cost to rent a room?
Yeah.
And you know what they're doing? They're going back to New York.
Oh.
Or they're going to other jurisdictions. They leave because they go, this is crazy here, you know? You can't live here, and then so, and then the outlying areas where a lot of our people moved, you know, they were going to Morgan Hill, Gilroy, Pleasanton. Now they're going out Tracy, you know, Manteca. They're getting further and further out, and
In
then
King City, a lot of construction in King City.
yeah, and then look at the traffic. I can't go 10 miles. How long does it take us to get to work if you're not there at 6 o'clock, right? 10 miles.
Hollister's ninth fastest growing city in the state.
Yeah.
But hey, Google's coming.
Continuing on.
Okay, this next slide shows the leverage ratios. On the top, we have the market value of asset leverage ratio, and that is the ratio of your assets to your payroll. And what that is a sensitivity measure of is your sensitivity to investment volatility. The good news for this year, as Bill had mentioned, is that we're seeing that level drop just slightly from last year. It was slightly above 15, now it's 15. And that is due to the fact that your payroll grew and more than your assets did. So you're just slightly less sensitive to investment volatility. But again, above the, you know, kind of off the charts in terms of the rest of the public plans database plans.
So let's
In-
actually ask that. You remember, Ann, roughly how many plans are in that database? 1,000, 10,000?
About 200. No, but-
200, and are
yeah,
we
about-
number
yeah.
200 out of 200?
I think so,
Yeah.
right? Didn't we look at that?
No, there are a couple others that
But
are.
I mean, we're like in the top
You are.
1%.
We did
of-
that for the
Yeah.
education session.
Oh, you did?
Yeah.
We
Good.
found like 3 plants.
This-
that
this
Were
is-
they
this,
closed,
uh,
though? Were they
Council,
closed
No,
this is
we
what
places?
Panic
eliminated
does.
Oh,
those.
okay.
This is what
okay.
Panic does 4 or 5 years ago.
Yeah.
First time we saw this chart. Went,
But
Yeah,
explain this
yeah,
a little
yeah,
bit.
so then, the police and fire plan are the black diamonds, and then the gold diamonds are both federated and police and fire together. So as a city, you're within that 25 percentile, up at the 5th percentile.
So when we take this and combine it with what we looked at earlier, the payouts of 271 million net on an annual basis, our leverage factor here, it makes sense on why the strategic asset allocation looks so different than our peers, and why our returns will look so different than our peers. And I guess the question on the investment side will be, are there other plans that have similar risk profiles but are achieving better returns than us? And does that make sense probably as I'm framing this? And maybe the returns aren't better, I'm not saying that they are, but I'm just saying, we shouldn't be looking at other plans that have the ability to take more risks because we can't afford to take more risk.
Yeah. We have a peer of one, right? I mean, it's ourselves. I mean, it's clear. We are off the charts. Cash withdrawals are going to be huge going forward.
Right.
And so to compare us to somebody who can actually take a significant of equity risk is not the right thing, right? And so by definition, if you compare us to our peers, we are going to be at the bottom in a bull market.
So why do we have that data on our reports then?
That's
You
a
know,
great
you start to
point.
think about it from that perspective, right?
That's what I've been telling Roberto.
And I've been telling Prabhu, it just goes with the market, where a public plan, when you compare it to the other public plans, that's really, I mean, you're correct, we are a peer of one, I don't disagree with you. And you Ryan, and the board, and yourself, Vince, have always made the point, but, and I'm gonna defer here to Councilmember Foley, because regardless of how we look at it, stakeholders are gonna compare us to everybody else. And so the information is there.
But isn't it our job then to correct that?
No, and we have been doing that job, apparently not that well, but we remind everyone every time we get a chance. We do it at the board meetings. I do it every time I go to a city council meeting, I make the point. We went to the working group, we made the point again. But it doesn't matter, we're gonna be compared to the rest of our peers.
Right.
Now, I'm not saying there are many peers, because there might be 1 or 2 plans that, not quite, but they may have similar characteristics, not quite the same. But aside from that, yeah, I mean, we're a peer of one, and, you know, we cannot take the risk. By the same token, you know, and this is something that I mentioned at the working group, there is a difference between an employer that does not have the economic feasibility to really make payments like the city of San Jose does, right? I'm not talking about the cash flow, I'm talking about the ability to really have the ability to come up with the payments at any given time. That is not really available to every employer. And the city does have that capability if they want to pull on that, but you are correct, so.
No, I'm gonna come back to this subject next year, when I'm not board chair, and think about how do we keep working on that messaging? Because clearly, it's not, we've been saying, for 10 years I've been on this board, we've been saying this, but yet we keep fighting this other battle, and we need to change that. And if it means that we need to figure out how to not talk about our peers, or to frame the discussion that we're the 1% at the bottom, from a risk perspective, somehow we gotta change that.
I got high marks for diplomacy, so I shouldn't say this, but it's easy to scapegoat investments, right? Point the finger at investments. That's not the reason we are underfunded, right? We can take a lot of risk. If our sponsor wants us to be top quartile compared to our peers, we'll take a lot of risk and then subject the sponsor to a 2008 meltdown again. We can do that, but we're being very sensitive to our sponsor.
Right.
Right.
Okay, thank you, Prabhu.
I think if I may say something.
Yes.
I mean, I think The investment committee, I think, should take it on to kind of devise what's the best way of measuring, you know, what is a goal for the plan to do, right, the investment staff, and then see, you know, what are the standards that we should apply. So I think right now, if you're sitting outside, you're going to look at this, well, we are, you know, bottom 5%, and that's not fair because, you know, a plan is different. But we should have a way of measuring what the number should be and see if we're meeting those standards.
Mm-hmm. Okay.
Well, we've talked about this for a long time, and to some extent it's pretty straightforward. We're picking a point on the efficient frontier. We talked about the 4-step, right? What's the level of risk, absolute and relative? Let's design a portfolio to do that. What's the expected risk discount rate? You know, Vince, I think, first of all, we have fallen below the efficient frontier a number of times, so let's fix that. No, we're not talking about that. That's just you banging on wood, you and Roberto and your staff, right? But I think, Vince, the right tool to do this is the efficient frontier, because I think everybody on the city council understands the relationship between risk and reward. And I think, Vince, you know, you sort of pointed us in this direction. I think to some extent, maybe what we ought to tell the city council is, look, we are going to demand that you be in the bottom half of that efficient frontier city because of this. But now you tell us, as Roberto's saying, you tell us, city, where in that bottom half do you want to be? Do you want to listen to this and say, I know I'm a strong city, but it scares me, and be near the bottom of that? Or do you want to say, you know what, guys, we agree with you. That scares us too, but by God, we're a strong city. We're a strong part of the country. And that's why I think what you sort of suggested in the past, Vince, is we pushed it down really hard based on this. Maybe the city, as you said 2 years ago, comes back and says, guys, we're a strong city, right? We can take some risk on at the city level. And that dialogue needs to take place, but man, everybody understands the efficient frontier curve. Everybody in their life understands risk and reward that they trade off against each other. And I think, to some extent, Vince, maybe, and you've talked about this for 2 years now, we ought to take that city and say, look, we insist you can be in the bottom half. You tell us where in the bottom half you're willing to be. And then I think we've kind of done our job, and they've kind of done theirs, because to some extent, it is a decision, right, Harvey, the city to say, how much pain can I take, right? And of course, we don't want to bankrupt them, we know that. But to some extent, right, Harvey, we set a range, and somebody else might calibrate us within that range, or is that not fair?
Well, it's our job. It's our job to do that.
So that's getting input from them then?
But respectfully, I think we've gotten that input.
I think we have.
I think Councilmember Foley at the last meeting told us, we don't want you taking on what we consider to be outsized risk. I think that ship has sailed with the city council.
Yep.
Correct me if I'm wrong.
Yeah, I think you're right. I think council is averse to risk. And I might argue with you a little bit that they all understand risk versus reward. We all take risks in our own personal portfolios, but we're not managing. You're trustees of the Police and Fire Board. We're trustees of the city funds. So I think they're very risk averse. They want to be in the highest return, but they don't acknowledge that the risk comes with that.
God, I
But
can't
you
tell you
would-
how
but
much this sounds.
You would sort of also agree, though, that we heard from the mayor, the city does feel pretty strong as a city compared to other cities around the country.
Every council meeting, the mayor talks about the recession being right around the corner.
Well, that's
So
fair, but that hits everybody.
There's a concern about ongoing liabilities and expenses and.
But you don't feel like
You
you're
know, the need-
Detroit or Stockton, by any
No,
means.
no.
And you don't feel like, I don't know, who's doing really well in the country right now in terms of growth? Yeah, good point. You know,
Puerto
somewhere in
Rico is
Florida,
also not
right?
doing well.
Yeah.
So.
All right.
Okay, continuing on, sorry to digress here, but this is such an important message. We'll figure it out.
So at the graph at the bottom of this chart, or the slide here, is the asset, or the liability leverage ratio, which is similar to the asset leverage ratio, except it's the liabilities divided by the payroll. And it measures the sensitivity your plan has to changes in assumptions or demographic gains and losses, such as investment losses as well, or, I'm sorry, not the investment losses, demographic losses, like mortality, retirements, and such. So this measure also has dropped from last year, again, due to your payroll growth. Here we're showing projected assets and liabilities and the resulting funded ratio. Historically, you can see the funded ratios on the left top of the graph there. And right now we're at 74%. And we are projecting that that ratio will steadily increase over time to come close to 100% by the end of the projection period in 2035. The lines there are the assets, and the bars are your liabilities. The bottom graph is showing the steady progression of the unfunded actual liability decreasing, and this is the total unfunded accrued liability, not the payments. It's just the total of that liability going down, mimicking kind of what the message is in the top half of the graph. Here we're showing the projected contributions. The top graph shows those contributions as a percentage of payroll. This valuation, the percent was 96%. We're going to see expect a one-year blip next year in an increase at 88%, and then steadily declining. And you can see with the new amortization adjustment option that that cliff that is showing it from 2026 to 2028 has been mitigated slightly. And then there'll be a steady decline after that. The bottom graph is showing your projected contribution amounts in dollars. Right now, for this valuation, it was $210 million. And you can see that the contribution dollar amounts are actually increasing over time. And that's a result of the fact that we're assuming increases in your payroll at 3.25%. But as a percentage of pay, they're actually going down. The next couple slides show the risk of the plan going forward and the uncertainty based on a stochastic analysis. And really what it's showing is the level of plan maturity you have combined with the volatility of investments. There's a very wide range of potential contributions. The slide before showing our nice projections and what those rates are going to be. That's if every assumption is being met, specifically your discount rate assumption of 6.75%. Here, we're showing the volatility in the market. And when you look just 6 years out into 2027, the range of contributions goes from anywhere from 20% of payroll to 120% of payroll. And this is the total plan. Just quickly, if you want to switch the next slide.
So this is Monte Carlo simulation,
Yes.
moving all variables around. Where's, roughly on that chart, where's the one signal point? Is where it sort of turns from dark to light, do you know, sort of? I remember we're in this chart. I don't think Excel necessarily interprets one sigma. Do you remember, Ann? I don't remember. I gotta go look. Okay.
We got, with this version of the chart,
Right.
we don't have.
Yeah,
The
no,
solid
and that's fine.
lines,
That's
exactly,
fine.
that's-
I
yeah.
remember when I looked at the chart, we talked. Okay, fine.
Right?
Yeah.
So the matter is, how smooth do we need to make this?
These two graphs represent tier 1 at the top and tier 2 at the bottom. And you can see all the variability in that contribution rate is coming from tier 1. Because it's a mature piece of the plan or part of the plan. And then you have your tier 2 contribution rate volatility, which is much less. I mean, it's markedly less. And again, that's because it's a less mature plan. And also a lot of the risk in the plan is being shared with the employees as well. So you get that different dynamic between the two.
Okay, now we're going to shift to the decision that we need you to make. So we started talking about smoothing out the payment pattern by adjusting the amortizations. This table shows the various pieces we've looked at. So prior to the changes, you have the two left columns showing the remaining amortization periods for gains and losses and assumption changes that originated in the years on the far left. So in 2007, the 2007 gain has 4 years remaining. We came to you with a proposal to smooth that out, and that's in that option number 1 original proposal. And we put in red bold all the numbers that changed. And essentially what we did is we took that middle grouping and put them all at 7 years, so that we were matching up some gains and losses on the same time period to smooth things out. That did a good job as a percent of payroll, and we'll revisit that. But there was a comment at the meeting that maybe we should look at smoothing that out as a dollar amount, because we were trying to smooth out things that went down and then back up. And so we were looking at smoothing it as a dollar amount. And so then we came up with this option number 2, which essentially so we left in those columns, the black bold are the changes from option number 1, and the red bold are the new changes in option number 2. And essentially all we did was we took those first 3 assumption change bases and changed them so that they had the remaining period as if it was 20 years from when they started, which is how we do things now. It's not how we did things back then. So it extended just the recognition period for those assumptions. We looked at this after these changes we developed before any of the valuation results were around. And so then we looked at it after the valuation results, and we added one more option where we take the 2005 changes and add one more year to those. We're also going to look at different rates of increase in the amortization payments. So currently, as Ann mentioned earlier, the amortization payments increase 3.25% each year, because we assume payroll increases 3.25% each year, and so they're designed to stay as a level percent of payroll, as long as payroll actually increases 3.25% each year. To make things level dollar, we needed to get rid of that increase and change them to 0% increases each year. So it's like you would have with a typical mortgage, where you pay the same dollar amount every year for the whole length of the time.
We're sorry, your conference is ending now. Please hang up.
Yeah, see you later.
Okay, I'm done. That produces level amounts as a dollar, but it increases the amount that you have to pay now. And when we looked at that combined with the assumption changes and the results of this valuation, that kicked the contribution up quite a bit. So we also considered something we had talked about back at I think at the retreat, of using 2.5%, which is our inflation assumption, so that we're paying essentially the same real dollars each year, but it's less than the expected growth in payroll. So it's somewhere in between what we were looking at as level dollar versus level percent of pay. Now, the other thing that came up was it's very challenging to compare these options. So the next 3 slides are our attempt to help get the relevant metrics. We also have the interactive model set up to handle all of these. So we'll try and walk through these and help you make some decisions. So this chart is looking at projected city contribution rates as a percent of pay. So the dark blue line is that original option. And we're starting with, all of them start with the 82.6 that was the 2020 rate, so that you can see what the change is. And So the dark blue line goes up to the 86.1, and then the next year it's 88, and then it drops down. And it follows this pattern. If we went to that option number 2 as a level dollar, you get this dashed line. So the contribution rate goes up quite a bit in the first year. But then, once you're there, it stays fairly level and grades down very nicely and is actually lower once we get out in here, and smooth as a percent of payroll. If we change and use it with a 2.5% growth, we get kind of a happy medium, and then the option 3 with the 2.5% growth really is just changing the rate in 2023. It's this trade-off, the rates through 2023, and after that, they're the same. Because whoops. The only difference is we're taking this one base that had 2 years left, and we're making it 3 years. So the difference between 2 and 3 only affects the next 3 years. After that, everything's the same. And so it follows this, this other pattern that is declining. It's smoother, but you can see you've got some lower rates in this interim period and then followed by higher rates. Now, this is the same graph on a dollar basis instead of a percent of pay projection. And so it just changes the relationships a little bit. You can see with the green dashed line, once we recognize the future investment losses that we have stored up, we get to a really flat period that carries us out to almost 2029 before we drop down.
Those are in real dollars.
Those are,
inflated.
no, those are nominal dollars.
So they're inflated?
Well, what do you mean by inflated?
Is it $100 in 2023 and $100 in 2024, or is it $100 in 2023 and $103?
No, it's $100 every year.
Real dollars. The city would maybe see their income go up. But
If they would see their income, but ours would go down. That's why,
Yeah,
as a
the
percent of
percent
pay, it's going down.
Right, got it. Thanks, Bill.
And that's why the blue line is going up here as a dollar, but here it was flat as a percent of pay.
Right.
So those are kind of the trade-offs you're taking, and then the 2.5% growth is kind of somewhere in between the two. The challenge here is it's not really an actuarial question about how you pay this off, because it's just how do you want the patterns, and we're keeping the adjustment to the patterns within a fairly narrow range.
Yeah, because they all sort of start and end up at the same place. You take a different journey to get there.
They take a different journey. So to try and summarize it, we looked at just the sum of the contributions in the first 5 years and the second 5 years, and then what the UAL would be at the end of 5 years or at the end of 10 years. And it's really not a surprise that the more you put in the first 5 years, the lower the UAL is after 5 years, and so forth. So amounts has the highest contributions in the first 5 years, pretty high contributions in the second 5, but it drops the UAL the most. So it's really kind of a policy decision about how you want to manage the costs. It's always nice for the plan to get more money in, because that improves it. But then it's the question of where do you hit the affordability parameters as you see them, and how do you want to spread those costs, What we were really trying to address is just the volatility piece that was hitting, that hits budgets in weird ways, because you have things go up and then down and then back up. So,
Before you move from this slide, I found myself spending a lot of time comparing the contributions here and the ending UAL values and what made more sense, paying more, obviously, up front to get that UAL down over time. And then in your subsequent slides, started to look at what the annual contributions would be to see, does that seem like it's a big ask and a big delta from what we had expected. What's missing here, I hadn't thought about until we started going through this, though, was what these numbers look like before you even brought in option one. Meaning, what was the expected UAL to be in 2024 and what it was expected to be in 2000, whatever the chart you just had up there was showing.
2025 and 2030.
And I mention that because when you look at this bottom chart, I pulled up this report from last year, and of course, everything's shifting. We were trying to fix that kink that went from 2026 down to 2028. This looks like there's still quite a bit of a kink in there, but actually, the drop was much more significant before we made this change. It actually went not down to 197 million, it went down to 131 million.
Right.
It was a dramatic drop-off. So I
So-
guess I'm wondering, going back to that prior chart,
So the two, we were trying to fix two things. I don't want to lose the other piece, which is right here, between 2022 and 2025, the rate went down and then back up.
Right.
Under the old. So we wanted to get that off, and then we were trying to deal with this kind of cliff that we had with a little bounce back. And so the original proposal has done that, and we had it on one of the earlier presentations, but because the contributions then merged after a certain date, and at that point, you're at the same UAL.
So you're
And
saying
so they got to the same UAL in what we considered a reasonable period.
so if you go back to slide 19, are you saying that the old approach before we looked at option one, the UAL numbers would have been the same in 2025 and 2030?
No, not in 2025 for sure. It might have been 2035 where they were the same. I would say certainly by 2035. I'm just trying to think how long those things played out in terms of the changes. But they got, I think it was shortly after 2030. Let me go back up here just a sec. Yeah, it might have been by 2030, because I'm just looking at where that big dip was and when we recovered, and it was like a year or two after the recovery, we were essentially back in the same place. And you're seeing that also, you know, the option 2 and 3 with the 2.5%, the difference between that and option 1 is really pretty small when you're at 2030.
Mm-hmm.
There's a much bigger difference at 2025, and that's reflecting how you are manipulating those contributions in the interim. But we are getting to the same place. Ultimately, the question is over what period does it change? Actually, here's another way of looking at it. So there's no change on any of them after the 2014 base that we changed to 12 years remaining. So that would argue that, that would argue that at about 2028, we're getting pretty close to about the same. I think some of the differences you're seeing ultimately are maybe differences in interest, like between the option 2 and 3 and option 1.
Okay.
You know what will be helpful is to know the numbers in the next couple of years.
Yeah, can you go to the chart that shows what the contribution will be in the next 2 years? Particularly that, we know the city's doing budgets over a 5-year period, and the expectation.
So very last chart, go to the very last chart.
That's the option 3 with the 2.5% growth.
Go to that very last chart,
Would
though,
it-
because it's got the.
Oh,
options
this.
compared, yeah,
Okay,
their
so let me,
impact on the budget. Yeah, go ahead.
let me put some caveats on this
Sure,
chart.
sure.
So, last month, the city presented their budget results, and they showed us their current general fund projection. And police and fire, almost the entire cost comes out of the general fund. It doesn't have special funds pieces.
I see the budget director, he's agreeing with you, he's behind you.
Oh, good,
Yeah.
good. We looked at those specific numbers, and the UAL payments they had in there match exactly what we provided. They have different normal costs because they're taking our percent of pay and applying it to a budgeted number of payroll positions that's different than what we're using.
Sure.
So what we did is we left that alone because the normal cost rates didn't change substantially, and we just said, okay, what's the difference in the UAL payment that we're talking about here, and how does it affect the budget shortfalls? So like on option number 1, compared to what they had in the budget, there's an additional 7.1 million in UAL payment in 2021. And so that would increase that shortfall just for that adjustment from 10.9 to 18. So that's how to read the chart. It's just looking at the UAL payment differences and ignoring everything else, and then adjusting their projections.
Thank you. And I'm sure the budget director thank you as well, because this is more their language. So, but this is very helpful.
So let me do just one quick comparison and see if this helps with trying to focus on the numbers. If we take on page 23, the contribution for 2021 aggregate, that number 209.6 million, if we stay with this option. If we go to the next page and we're more aggressive, it jumps by about 11 million.
Mhm.
So how aggressive are we willing to be, and what does this do to the city's budget by us saying, we want more money in now, and all of a sudden, the impact to city services has to change because we're making those decisions?
But there's other options.
I'm
beyond-
sorry?
There are other options beyond that number 2, right? There's,
Well, yeah, I'm just using, those are the two most extremes. That's why I'm
Yeah,
using.
so in the first year, option 1 increases the UAL payment by 7.1 million compared to what they had in the budget. Option 2 by 20 million. If it's level dollar, a 0% increase. With a 2.5% increase, it adds 3.4 million. And if you go to option 3, it actually reduces it by 0.7 million in the first year.
So I don't know if I understood this correctly, but right now, if the board does not make any changes, the total contribution for the 2021 year will be $209.7 million.
Right.
If they go to the first option, basically 223 million.
Yes.
The next one, 206 million, and option 3, 202 million.
Right.
Okay.
But there are impacts beyond the first year, right?
No. Understood. Understood. I was just looking at 2021.
Right.
Yes, I agree with you. I mean, the board has to look at it in a combination of things, right? Including, I wouldn't just agree just to 1 year. Probably the next 2 or 3 years makes especially if we think. I think there was a presentation some time back, and I'm not saying that this is correct, but there's a presentation by Verus that indicated, based on their due diligence that they did, that it takes about 18 months for a downturn in the economy to be reflected in the numbers, but the city budget. That was their word, meaning Verus. I don't know if it's 18 months, I don't know if it's 12 months, but if you think there's gonna be a recession in the next few years, say if it's in 2021, it probably won't be completely reflected in the budget numbers until the 2023 year. I think that's the way. I'm not suggesting that the recession is coming in 2021, by the way. I'm just making the statement as a discussion issue.
So can I try and cut the chase on this, on how I was looking at this? Can you go to slide 19? I was just trying to look at the extremes here. If you take option 1 and the first option, number 2, which is the 0% increase, you add up your total contributions from 2021 to 2030. By selecting option number 2, you would have actually contributed about $29 million more than where your baseline option 1 is right now. But in the end, in 2030, your UAL is $64 million less. So by contributing $29 million more today, your
73.
UAL is $64 million less. It seems like it's a easy decision. That is, assuming in that 1 year, actually it's more than just 2021, you can hand a bigger bill to the city.
It assumes that you earn 6.75% each year on that money.
Mhm.
That's where it
Because
comes from.
it's like basically you're paying your mortgage more quickly, so in the end, you've got less to pay off. And rather than us, which we've consistently done, adjusting the discount rate, adjusting the discount rates, which we've needed to do because return expectations
get
were
down to
unrealistic.
reality, yeah,
It
right.
did have the effect of bringing in more contributions into the plan. This is another way of bringing more contributions into the plan, but it's only coming in directly from the city and directly towards the UAL. So option number 2 with a 0% increase is a pretty intelligent way to go if we believe it doesn't dramatically impact the plan sponsor and city services.
I think that we still need to ask that question.
Well, that's what I'm throwing out there. We've
Well,
got an
so go back to-
audience.
Go back to slide 18, one slide earlier. So I think that's right, Vince. I mean, you're comparing the dashed line to the gold line. And the dashed line, we pay a little more now, as you can see, in the early years, and then a little less later. And the gold line, which is the 2.5%, we pay a little less now, a little more later. You know, the one thing that is attractive to me about the dashed line is I'd like to think that other things being equal, giving the city something that's very stable is helpful to them to plan their budgets around. And the dashed line, as you pointed out earlier, Bill, is exceptionally stable over a decade there. Well,
Yeah,
almost a decade, yes.
but that assumes that
Yeah,
all
everything
the
else. Right,
assumptions
sure,
are matched.
sure.
So
Make the
the
return
actual
on
numbers
everything
are
else
gonna move
right.
around.
Yeah.
Right. But a plan's already volatile. We miss our numbers, it's gonna be more volatile. So a less volatile plan, we miss our, anyway, I catch your drift.
So, any comments from the audience?
You can either stand or you can sit, whatever is
Go
easier for
it,
you.
Please,
Yeah.
thank you.
Hello, Jim Cannon, City's Budget Director. Thanks for having a really interesting presentation. Thank you for all the slides from Chiron and the last one that talks about the impact to the forecasted deficit. Really helpful. So I think that, the comment I would offer is just kind of a little bit more of a reiteration of maybe the training that we kind of gave with Julie and I were here the last time, talking about where the city's budget position is, and you kind of see it there. So we have historically been, for the last, 5, 6, 7 years, kind of bouncing along the very balanced budget. In any given year, we might have a little bit of surplus, might have a little bit of a deficit, but not a lot of change either way, which is positive given where we had been in the past, where we had seen some really significant cuts that we had to make. But that means that any sort of change that we do in any current year is going to impact service levels in that year. So although we need some of this information to figure out what our preliminary forecast is for next year, so it's kind of a cart before the horse, because I don't know if that $10.9 million figure, all things being equal, is exactly the same, because that was number produced a year ago. But what's likely is that if, something like an option 1 makes it a little bit harder to close that gap. Option 2 makes it really tough. From a plan sponsor perspective, having a deficit, closing a deficit of $31 million, all things being equal, is a service level impact to the organization and to the community. And so similarly with option 3, that's pretty much of a status quo. One of the things I was observing is on the lines, it looks like, shockingly, the smoothest lines look like option 2, 0%, and option 3, 2.5%, which is, I just thought I was I was a little bit surprised to see that. It would also change, interestingly enough, what we had been seeing for the last few years, we had been seeing that 2023 line as being, hey, this is where we're going to get the big surplus, big surplus, given the relative size of the budget. This smoothing effect, changes that story, which is, I think, was one of the objectives, was to kind of maybe smooth that out, so that's not necessarily a bad thing. Since this is the Police and Fire Board, I'll throw it out there, is that we will be having, ideally, in 2025, 26, new fire stations coming online, which will be new engine companies, and so there'll be some increases to the normal operating budget general fund that aren't reflected here because they're just outside of the last 5-year forecast. I think in general, the way the city's budget best absorbs things, I think the city, from an administration perspective, wants to make sure that we always have a balanced budget and we have a path forward, to make sure that we are fiscally sound and thoughtful about the services that we can provide. I think, from my experience being here, the steps that the boards have taken to get the plans in a better footing have been good. And I think the way that we have generally, absent crises, stepped into those on a measured basis have also been helpful. I think that's maybe the comment that I'll make there.
I'm going to make a motion, and we'll see where we go from here. I'm going to make a motion that we adopt option number 2 with the 2.5% increase. And if someone wants to be more aggressive than that, they can discuss that as if I have a second on my motion.
I'll second.
Okay.
So
So
Bill,
discussion.
Bill, will you pull up slide 18 again, just so I can make sure something, Vince,
So
before we
you
go forward? I
increase
think I generally agree with Vince. So Vince's suggested option is that green line, it disappears because it merges with the yellow line?
Yes.
And then
so
it's all the same after that?
It's all the
as well.
same as the
Yeah.
yellow line
Because-
after it.
Yeah.
It's
In the
just
end.
this.
Yeah. I
My
think
UL
that's
is
about
actually a
right,
little bit lower.
Vince.
Yeah.
That yellow line is attractive, and I think the green line puts a little more in the bank up front than the yellow line does. So yeah, that makes a lot of
Does
sense
the
to me.
present employee pay more?
Sorry?
Does the present employee pay more?
This does not impact, this is only the employer. That's the impact of only adjusting the amortization as its city contributions, not member contributions. Right. And if we go to slide 19, this is showing that in 2030, option number 2 with a 2.5% increase, you're not drastically ahead, but you're a little bit ahead of option 1, and that the UAL would be lower in 2030. It wouldn't be there in 2025, but you now have a smoother dollar contribution. I don't know. I think It's either that or it's option two, where you're just more aggressive and you're gonna ask for more money up front, in my mind. But,
Well, I think we heard from the city how difficult that would be.
right, that's what concerns me, and, I think we're trying to balance everything out as trustees, providing, a stable plan, looking out for the members of the plan. Option number two versus option one does, in the 2030, provide more security for plan members.
Yep.
And the plan sponsor, it's also something that's less impactful as well.
So back to slide 18, Bill. God, I feel like we're counting how many angels could dance on the head of a pin, but in the beginning years there, that green still bounces around a bit. Is there any value to smoothing that little Z there
Well,
at the beginning?
that was the idea of option three, was
That
really
was the idea of option
to
three.
deal with that
Yeah.
little dip that happens there. So
Mm-hmm.
you have slightly lower contributions in 21 and 22,
Yeah,
and
yeah,
then
yeah.
higher in 2023, and after that, you're the same.
So is there advantage, Vince, to going with option three then instead? I mean, I sort of am intuitively grasping what you're saying, Vince, is things are good now, let's put a little more in the bank now. But we're gonna see a little wobble, but the city seems able to grab the concept here, we're gonna wobble a bit before we stabilize.
It's a difference of 2 years. Than
Yeah,
you're saying.
no, I got it. And I do like the idea of starting out of the gate a little bit faster.
I mean, I was option three, but, I mean.
They're almost, I mean, they're virtually identical for 90% of the time.
Right.
I'm supportive.
I'm open to an alternative. It's,
Yeah. Option two at 2.5 is a nice balance between the
Yeah.
option one, two.
I think that's the right choice, Vince. I'm 100% supportive of that motion.
Yep. I would.
well, I'm gonna, ask for a vote, and if it doesn't pass, somebody else can propose something else. So, all in favor, who seconded my
I
motion?
second. Yes,
Okay. All in favor of the motion?
Aye.
Aye. Any opposed? Sorry, what did you say? Did you say aye? Okay,
Always a bridesmaid, never
I was
a
a little
bride.
delayed.
okay, and there were no opposed.
Yeah, that's a good choice then.
Okay, motion carries.
Thank you.
Great job.
I'm sorry. Well, I knew that was gonna be a tough discussion and lengthy. We'll wrap up the other ones more quickly. So we have item 4D, acceptance of the nomination of position for board vice chair. Trustee Lonzo, you were not here, but you were nominated.
I told him I'd serve if called.
Does that mean you accepted the
So are you
nomination?
That
accepting?
means I accept the nomination.
Okay, do we need anything more than that?
And then the vote
There's
takes
a vote?
place in January?
Okay,
Yes.
great.
Okay.
All right, thank you very much. We got our team for 2020.
Go team.
All right.
Okay, moving on to discussion on committee assignments. Knowing that the board was going to transition, I've had some discussions with both the incoming board chair and vice chair, and I'm going to propose a slate on the committee side and chair positions, and then open it up for discussion. We'll see if everybody can kind of keep track of all the proposed changes, but this is significant given the fact that Gia is coming off the board and has certain roles on the board, particularly being chair of the investment committee. So I'm going to start with the investment committee first, where Gia will be coming off. I'm going to propose that trustee Lonza join that committee, particularly because of his expertise and knowledge on venture capital investing. We do get the benefit in joint personnel committee meetings from Federated, where Anurag is in that industry. We don't have the current benefit there on the police and fire side unless we bring Drew on. Drew seemed to be in favor of that, so I'm going to propose that. And what I'd like to do is propose that we have Vikas chair the committee and Eswar become vice chair of the committee. I think in that structure, we had Vikas come on first, Eswar come on second. So I think the term that Vikas has had is almost all of 2019 on the committee, and Eswar has been maybe a few months or so. So that puts you in a position to be chair in the future as well of that committee. So that's what I'm proposing for the IC. Correct.
You did check with Vika?
Yes, I did.
Okay.
So now we move to audit, and I tried to balance everything out so that we don't have this overburden of trustees carrying on too much responsibility. We currently have Drew as chair of audit, Franco as vice chair. I'm going to ask if Franco would chair that committee. And Eswar would remain on the committee, and Nick, if you would consider joining that committee. Okay? Moving to governance, Franco, I'm going to ask if you would like to come off that committee. I know you're, I think, heading towards retirement, and so your load, we're trying to kind of lighten your load a little bit. But
That should increase.
we're basically shifting you from chairing one committee to another. Dick, you're currently an alternate, and I'd like you to actually become an actual member on that committee, on governance.
I was there before.
Okay, good. And then I would join that committee, and I think it's just a matter of who chairs it, myself or Nick. I don't actually know if we need to decide that now. We can decide that at the first committee meeting. So that committee would consist of myself, Nick, and Dick. I don't know if we even need an alternate for that committee at this point, unless Franco wants to be the alternate.
He didn't even look this way.
Do we need an alternate for governance?
Well, I think we were having trouble, so that's why we requested an alternate, because we were having trouble getting every quorum, so.
Would you be the alternate, Franco?
The governor.
For
the one
governance?
You were the chair for. It may be helpful because he was the chair, he was very much involved. In fact, he has a meeting right after this one.
Yeah.
Wait, isn't this effective this meeting?
No. No, sorry. Okay.
Well,
That's,
the whole point in an alternate, I remember Dick had proposed it, is that if the chair could not be present, the meeting can continue.
yep,
Yeah.
good. Disability, no change on that committee. Joint personnel, that would be a bigger change there. So what you have is the board chair sits on joint personnel, so that would be Andrew joining that committee. The chair of IC sits on that committee, that would be Vikas joining that committee. Gia is coming off that committee, and I'm currently chair. I think from a continuity perspective, it would make sense that I stay on the committee, but I don't have to be chair. It could be time for Federated to potentially chair that committee, but I would stay on and Nick would come off. So basically, Nick's getting a little bit of shuffle around from different committees. How's that sound, folks?
Good.
Everybody? Gia,
Sounds
you okay with that,
good.
Gia?
Sounds good.
All right.
And you're gonna leave Dick and I doing disability, right?
No change at all on disability. Yep. So that is the proposal and the motion. I need a second. Franco, second. All in favor?
Aye.
Any opposed? No? Okay, we'll see if we can make sense of everything I wrote down later on and we remember it. Moving on to service retirements. As Franco mentioned, we have a lot this month. It is typical in both December, January, when we go through the agendas, we have a lot of retirements, so I'll read that off. We have Glenn Baldwin, police officer, police department, effective January 11th, 2020, with 27.53 years of service. William Becerra, police officer, police department, effective January 11th, 2020, with 25.05 years of service. Lawrence P. Birch Jr., police sergeant, police department, effective December 28th, 2019, with 29.43 years of service with reciprocity. Mark C. Bustillos, Deputy Chief of Police, Police Department, effective December 14th, 2019, with 27.46 years of service. Richard Foster, Police Sergeant, Police Department, effective December 14th, 2019, 27.46 years of service. Eugene Gaines, Police Officer, Police Department, effective December 14th, 2019, with 25.3 years of service. Daniel Gambin, Jr., Fire Prevention Inspector, Fire Department, effective January 11th, 2020, with 24.9 years of service. David C. Gutierrez, Police Sergeant, Police Department, effective December 14th, December 14th, 2019, 27.11 years of service with reciprocity. Jose Maria Iglesias, Police Sergeant, Police Department, effective December 14th, 2019, 27.03 years of service. Lyle T. Jackson, Police Sergeant, Police Department, effective January 25th, 2020, with 25.46 years of service. Alexander S. Kelleher, Police Officer, Police Department, effective January 11th, 2020, with 27.52 years of service. Bertrand Milliken, Police Sergeant, Police Department, effective December 15th, 2019, 28.61 years of service with reciprocity. David N. Mosley, Fire Department, effective, Fire Engineer, Fire Department, effective December 14th, 2019, 27.18 years of service with reciprocity. Jeffrey R. Mushak, Fire Engineer, Fire Department, effective December 21st, 2019, 23.43 years of service. Vanessa Payne, Police Sergeant, Police Department, effective January 11th, 2020, 29.23 years of service. Anastasio D. Ramirez, Police Officer, Police Department, effective January 11th, 2020, with 22.88 years of service. Joseph K. Stewart, Police Sergeant, Police Department, effective January 11th, 2020, 27.53 years of service. James Ton, Fire Engineer, Fire Department, effective December 28th, 2019, 27.44 years of service. Alberto Valdez, Police Officer, Police Department, effective December 14th, 2019, 25.16 years of service with reciprocity. Jeffrey L. Welch, Battalion Chief, Fire Department, effective December 14th, 2019, 25.4 years of service with reciprocity. Wilson Young, Police Officer, Police Department, effective December 14th, 2019, 25.33 years of service. And Bruce Young, Police Lieutenant, Police Department, effective January 11th, 2020, with 28.8 years of service with reciprocity. If this doesn't make Franco's point clear, I don't know what does. It's
And there'll be just as many next month.
Yes.
amazing.
Maybe as many next month.
Oh, my gosh. So you'll get to read all those names off next month, Andrew.
Wow.
It's a lot of years of service going out the door. Thank you for your service. I'm going to ask if anyone wants to comment at all. There's a lot of names on here, but feel free. Dick
Well,
first.
I'm happy that you all joined our ranks and they're healthy. Hope everything works out for everybody. And thank you very much.
Good.
Just congratulate them all on, happy, healthy retirement and 200 and 250 years of service walking out the door.
Yeah. Okay. Any comments, Nick?
It's funny, I had the pleasure of knowing all of them and working with most of them. And just as Franco says, I hope that they live longer in retirement than they were in service to the city, but they all served with honor and distinction. Wish them the best of luck.
Yeah.
Sorry to see them all go.
Okay. Thank you.
Second.
Okay, motion by trustee Santos, second by trustee Muyo. All in favor?
Aye.
Any opposed? Okay. Deferred vest, Paul Chrisman, Police Officer, Police Department, effective December 21st, 2019, 28.18 years of service with reciprocity. Humberto Rangel, Police Officer, Police Department, effective December 30th, 2019, 31.09 years of service with reciprocity. And James W. Sims, Police Officer, Police Department, effective December 20th, 2019, 28.01 years of service with reciprocity. Do I have a motion to approve? Okay, do I have a second? Second. Great. Motion by Santos, second by trustee Muyo. All in favor?
Aye.
Any opposed? Okay,
Just real quick questions, that either maybe Barbara or Roberto, you guys have any idea as to these last three defer vested? Considering they're all over 50 years old and they all have more than 25 years of service, why it's a defer vest, not a retirement?
They must have separated from the city. They must be currently separated from the city and working at the reciprocal agency.
Oh, got it.
Yeah.
yeah,
Yeah.
because they're all reciprocity.
Got it, okay.
Okay, then I'll read off the death and survivorship notifications and ask for a moment of silence. We have the death of Kenneth W. Barber, police officer, retired April 15th, 2008, died October 13th, 2019. Survivorship benefits to Marie Lahirson, spouse. And the death of Greg Rosenden, police officer, retired July 12th, 2012, died October 8th, 2019, no survivorship benefits. Have a moment of silence. Okay, I'm not sure if Franco or Nick, you are familiar with either of these individuals?
Well, this is where it starts to get scary, because Ken Barker and I actually work together. So, yeah, I know, right? So I'm very sorry to hear of both of Greg and Ken's passing. So our condolences to their family and friends, and thank you, Chairman, for the moment of silence.
Okay. Last leg, we'll run through committees quickly. Committee minutes reports, our last report from Chair Griarte on the Investment Committee, 7.1.
Well, since we've moved every other month now, I reported last month, so nothing new to report. We're going to talk about your plan for next year, so we
Yeah.
are looking forward to it.
Great, thank you. Any questions for the chair? Okay. Audit Risk Committee?
Yeah, same thing, nothing to report.
Okay. Governance Committee, Chair Votto.
Same.
All right, they've got a meeting following this, so I'm sure he's eager to get to that. Disability Committee, Chair Santos.
I was just told by Roberto that we don't have a quorum for the Monday's meeting, and so we're going to refer to the 16th. So I got to go home and get my schedule, make sure we can make it.
Yes. Are you available the 16th, Trustee Lanza?
I'm pretty sure, January 16th?
Yes.
Double check.
January, December.
I'm sorry, December 16th, so
December
not this coming
16th.
Monday, but the first one.
I can make that one. I have to head for a board meeting in Catalina, but I can do the 16th.
Okay. All right. Joint Personnel Committee, nothing to report. Last meeting took place, we updated the board last month on that. We were working on one meeting date that we had to revise, so we're trying to get something in before the end of the year. Any proposed agenda items?
Yes, Mr. Chairman.
Yes, sir.
I would request, if possible, have our legal counsel, Zimmerman, make a presentation that I had the privilege of sitting on here about a week ago about retirement systems. And since we'll have maybe new people, and I just think it's a good presentation about retirement in general. So I'd like to see that on the agenda,
Okay,
in that presentation, with your permission.
sure. Harvey, you're familiar with which presentation he's talking about?
Yeah.
Okay.
Now, part of the target audience is for new trustees that are going to possibly be on, or,
It's actually for everybody.
okay. Is there?
Especially the people who apply for retirement, who work
Yeah.
in it, the officials, trustees. It's just a good presentation. When I sat with everybody there was, very saying, hey, this is really good. It's education.
Okay.
Okay, good. Any other proposed items? Gio, you want to propose something that you're not going to be around for? Any public comment?
Just one. I guess that's not public.
No, but go ahead.
Before we close, yeah, I just wanted to throw my 2 cents into the ring here. Everybody made some really nice comments, and as Vince said, your leaving is really leaving us with some very large shoes to fill. If we can find somebody half as knowledgeable, half as passionate about what you do as you are, then we're going to be ahead of the game. But on a personal note, thank you for always making me appear smarter than I am whenever you sit near me. And then when you leave, then I'm dumb again. But seriously, though, continued success to you and best of luck moving forward. We're going to miss you, so thanks for everything you've done. Appreciate it.
All right, great.
Before you adjourn, I just want to remind everyone, you see over here, the next meeting is not the first Thursday of the month, so do not show up here on January 2nd, please. It's January 9th. We will send you an email to everyone to remind you, but it's the 9th. Also, on my comments, I forgot to mention that tomorrow afternoon is our office holiday event. We're going to be closing the office in the afternoon, and we're going to have an event with staff to celebrate the holidays. Thank
Terrific.
you, Mr. Chair.
Good. Okay, with that, meeting adjourned.